Senators are dismissing House Speaker Mike Johnson's call to send the National Guard to college campuses. Johnson visited Columbia University last week. He condemned pro-Palestinian protests and said there that it would be, quote, appropriate for the National Guard if demonstrations were not contained. Both Republican and Democratic senators have dismissed the idea. J.D. Vance of Ohio said maybe just call the police, while Tim Kaine of Virginia called it a very, very bad idea. Apple, yet again, facing antitrust headwinds in Europe. This time, it's the iPad. It's going to be added to a list of products that fall under the EU's Digital Market Act. Now, Apple has 6 months to comply with a whole set of new obligations and prohibitions. It's things like allowing the iPad users to download apps outside of Apple's store. It is a clear loss for Apple, but it also underscores the willingness of EU officials to go after big tech, already having taken aim at Microsoft, Meta, Alphabet, Amazon, and ByteDance. That's your brief, John.
Hey, Danny, thank you. We'll catch up with Danny in about 30 minutes' time. Up next on the program, the Fed's change in tone.
There's both a story here about the economy holding up very well with high interest rates, as well as inflation pressures being persistent. I think the case for Fed easing here is pretty small anytime soon.
The Federal Reserve decision 2 days away. That conversation up next.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equities positive here by 0.2% on the S&P 500. A lift again, adding some weight to the rally from last week. Yields are lower. That's helping things. We're down 4 basis points. On a 10-year, 462.18. Under surveillance this morning, the Fed's change in tone.
There's both a story here about the economy holding up very well with high interest rates, as well as inflation pressures being persistent. I think the case for Fed easing here is pretty small anytime soon. We'll see what we are 6 months from now. But certainly the Fed's going to have to change its tune about its view that there's a fair amount of easing that's coming down the road.
It's the latest this morning. Sticky inflation data reinforcing the high for longer narrative as the Fed kicks off a 2-day meeting tomorrow. Jay Bryson of Wells Fargo writing this. Stubborn inflation and resilient economic activity through the first few months of the year have left the FOMC little reason to ease policy in the near term. We currently expect the FOMC to first cut the Fed funds target rate by 25 basis points at a September meeting. Jay Bryson joins us now for more. So, Jay, before we get into the Fed call, I want to talk about the data from last week. For all the talk of US exceptionalism over the rest of the world, how exceptional was the first quarter in US growth?
Well, I mean, the U.S. clearly grew faster than the rest of the world in the first quarter. Now, we grew 1.6% annualized. I would say it was actually stronger than that. A lot of that drag was from inventories and imports, and, imports show that domestic demand is actually pretty strong here. But if you look around, the rest of the world, maybe you're eking out positive growth rates, in the EU, maybe you got to eke out a positive growth rate in the United Kingdom. But, in general, the U.S. is outpacing its major trading partners at this point.
Jay, you kind of alluded to it. Just how compatible was that downside surprise on GDP with the rest of the data we had for the first quarter?
Yeah, so, again, it comes down to inventories. There was a fairly large inventory drag. It's sliced off about a full percentage point. And if you look at net exports, that was also close to a half a percentage point as well. And so if you dig down a little bit further, consumer spending grew 2.5%. That's a solid growth rate. We eked out a positive growth rate in terms of fixed investment spending as well. So if you look at the underlying core of the U.S. economy right now, growth in those main drivers of GDP growth is pretty strong.
Let's dig into your Fed call and the month. The month jumps off the page for me, September. Jay, we've had a lot of characters around this table who have said September's not doable because it's too close to the election. Why are you running with September?
So first of all, John, what I would say is the risk to that view of September are probably skewed to the backside, right? After towards the end of the year, I'd certainly acknowledge that. But between now and then, you will get 3 PCE prints. You'll get 3 more non-farm payroll prints as well. Could they cut rates in September? If things are slowing down enough, then yes. Does the election just freeze September? No. The Fed would prefer not to be moving in September. But if you do see, a significant deceleration in the economy, if you do see the 3-month annualized rate of inflation coming back down to 2.5%, 2%, you could potentially see a rate cut in September.
So this is Lori. One question for you on your September call is what really gives you the confidence that the inflation data is going to cooperate by September to give the Fed permission to go ahead and cut? And I would say number 2, when you're thinking about, the potential for the hike conversation to come back in, how bad do you think the inflation data would have to be for that conversation to pick back up in markets again?
Yeah, so Laura, let's take the second question first. I mean, I think what you would need to see for, the rate hikes to come back onto the table, I think you would need to see a continued string of 0.3, 0.4 in terms of the month-on-month change in the core PCE. That would show you that inflation is just not coming back down to, the 2% sort of target that the Fed is looking for. And I think that's what you kind of need to see that. Now, so what are we looking for going forward? So we do think that, and the data would show this, that if you look at housing prices continue to decelerate, at least in terms of, what you're actually seeing out there in the real market in terms of rents. We think that will come down. The labor market is also getting into better balance in terms of supply and demand. The quit rate is back below where it was before the pandemic. The vacancy rate is also coming back down to where it was before the pandemic. And so as the labor market gets into better balance, that should slow the rate of wage growth, and then that brings back down the super core rate of inflation. So that's kind of what we're looking for in terms of, the Fed easing later this year.
Jay, you say that the election doesn't make September unmanageable, but what about November? Could they, 2 days after the election, come out and do something in November?
Yeah, and so that's kind of tricky, right? If they are on pause in September, they're going to get a lot of pushback from one side, and then if they go ahead and 2 days after the election they're cutting rates, they're going to get a lot of pushback for saying, these guys just held rates in September to help one side here. So the election does complicate things for them. But if you go back and you look at in other election years, they have moved before, right on the eve of an election. So it doesn't rule it out. It complicates their messaging. It complicates what they're trying to do, but it doesn't necessarily rule out a rate move in September.
Jay, just on the politics, a report from the Wall Street Journal last week that the former president and the team around him reportedly are considering how to be a little bit more assertive around central bank decisions in the Federal Reserve. I'm being diplomatic here, Jay. Jay, I just wonder what your response to that actually was. Do you know how that would work in practice?
I guess I don't really fully understand the question, John. But I guess what you're alluding to here is, I think there will potentially be more political pressure on the Fed if the former president is reelected. He put some political pressure on the Fed before, and you could imagine that going forward as well.
You answered the question in the spirit in which it was intended. Jay, thank you, sir. Jay Bryson of Wells Fargo. Jay, appreciate it, following that Wall Street Journal report just last week. MH, what did you make of that?
Well, let's go to what Terry Haynes had to say over the weekend. He came out with a note saying, quote, forget about it. Because when it comes to the central bank, the Fed, monetary policy is Congress's job to mandate. And to give that to the central bank to look at their dual mandate has nothing to do with the president. But, of course, when you look at potentially who's going to be around the president, you can have some sort of initiatives that would potentially make it a de-dollarization path forward. Yep. They want a weaker dollar in terms of exports, but nothing, at least to Terry Haynes, says that Congress nor the courts are going to be able to do to give that authority to the president.
I'm guessing Jay knew exactly what I meant. Anne-Marie mentioned a little bit earlier in the programme, should the Fed be guided by the economic data or guided by the communication we're getting from corporate America? Laurie, can we finish on this quote from Walmart? At Walmart, we're now seeing prices that are in line with where they were 12 months ago. I haven't been able to say that for a few years now. That's an executive speaking to ABC. We've heard echoes of that coming out of the company. What do you think we are learning from corporate America?
So I do feel like the inflation commentary is a little less hot than what it was in the last reporting season, and that's a good sign, right? We're not even halfway through this thing yet, right? So we've got to see what comes out in the next few weeks. But I do feel like it's just a more mixed, more nuanced conversation. I think companies last quarter seemed to really do a good job of keeping expectations in line and talking things down. I'm not noticing that this time around, and we've actually seen S&P EPS, the bottom-up consensus has moved up $2. So we'll see if that continues, but I feel like they've done a good job the last year or so clamping down expectations, and the setup's actually pretty decent.
Big story later this week on the earnings front. Amazon coming up tomorrow, Apple on Thursday. Laurie, love this. Good to see you.
Thanks for having me.
Thanks for being with us for the hour. Laurie Cavassini there for RBC Capital Markets. Let's set up the second hour of Bloomberg Surveillance. Joining us for the next 60 minutes, we'll catch up with Jay Pawlowski of TPW, Bloomberg's Trade Down, the latest with Tesla, Tom Forte of Maxim Group, looking ahead to earnings this week, including Amazon tomorrow, and we'll catch up with the brilliant Chanel Desai of Franklin Templeton on this bond market going into payrolls and the Federal Reserve. Equity futures positive here by 0.2% on the S&P. Bond yields are lower by 4 basis points on a 10-year, 462.26. Live from New York City, this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The stocks are starting to get a little flashy. We liked them more a few months ago when they were a bit more humble.
We think that valuations are fair. For the S&P to work as we go through the rest of the year, we need to continue to deliver on earnings growth.
The risk for equities now is less about earnings and more about valuations.
We certainly see more value in being able to find opportunities in the U.S.
There's been a lot of good news priced into a lot of the big tech companies. This is a chance to really kind of show me what does the rest of 2024 look like, and then we can go from there.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
2 more trading days left before we kick off May. Where is this year going? April has been absolutely bruising. So we closed out last week and the headline runs, biggest weekly gain on the S&P 500 of the year so far. And I remembered the headline from the week before, which was the biggest weekly loss on the S&P 500 of the year so far. We have been absolutely everywhere, and we'll be everywhere this week as well. We've got earnings data and a big Federal Reserve decision. Here's your week ahead. It looks a little something like this. The Amazon story kicks off after the closing bell tomorrow. Wednesday, Federal Reserve rate decision. Apple earnings coming on Thursday. Lots of trouble, down double digits through most of this year. Big problems in China. We'll be talking about them in just a moment. Friday, the payrolls report. The median estimate in our survey so far, 250,000. If you want to kick it off with this market this morning, before we get to all of those events, we need to talk about not the equity market, not the bond market. We need to talk about foreign exchange and this currency pair right here. Dollar yen, overnight, all over the place. So let me give you the range. Higher the session, 160.17. Lower the session, 154.54. Current price, 155. This is the official line from the Ministry of Finance. No comment. That's the official line. This is the story coming from Dow Jones. Japan's financial authorities intervened in the FX market. So we had a public holiday, low liquidity, yen's been bullied all month, and it looks like, based on reports, that the Ministry of Finance stepped in. We'll try and get you some more details on that throughout this morning. If you want to know where the price action is in the equity market, equity futures adding some weight to last week's rally. We're up by 0.2% on the S&P 500, a little bit of a lift there. In the bond market, yields are lower by 4 basis points on a 10-year, 462. On a 2-year, we're down 2 basis points at about 4.98. Outside of the yen, in FX on the euro, we're firmer here, 107.16, euro dollar positive by 0.2%. Coming up this hour, we'll catch up with TPW's Jay Poloski on why the dollar could be ripe for a sell-off. Tom Forte of Maxim Group previewing earnings from Amazon and Apple, and Sonal Desai, Franklin Templeton, on why this will be a, quote, short and shallow rate cutting cycle. We begin with our top story, kicking off a week of jam-packed data, a Fed decision, some big tech earnings as well, and a US jobs report to wash it all down. Jay Poloski at TPW Advisory writing this: we remain constructive on the fundamentals for the US and global economy. We are developing a line of thinking on the dollar that suggests it could be ripe for a momentum sell-off. Jay's with us for the hour. He joins us around the table. Jay, good morning to you.
Morning, John.
Let's start there. That smells like peak US exceptionalism to me, that call. Is that what this is?
Well, it's kind of like that, John, right? I mean, you read about the wrecking ball of the dollar, and you read about how strong the dollar has been, and yet the reality is that over the last 6 months, the dollar is actually down 1%, DXY. You look over the last year, the dollar's up less than 4%. So the dollar, again, is a one-off situation, right? It's the extreme because it's the most extreme interest rate differential, right? Rates in Japan is virtually zero, rates in the U.S. 5%. Obviously, that's where people are going to play the game. And so the rest of the world, it's nowhere near as extreme as that. And our view is that the rest of the world is starting to recover. The U.S. has already had its peak exceptionalism, right? It was last year. This year, going forward, the rest of the world recovers. China's growing at 5%. Europe is actually escaping recession. Japan is doing well. And therefore, we think, like big tech, right? There was that momentum run. They all ran the Magnificent Seven. Then they rolled over very hard and very fast. NVIDIA down 20%. In less than a month, okay, the poster child for AI. So for us, the dollar is ripe for a sell-off. You have the longest speculative position in 5 years in the dollar. Biggest long position in 5 years. You have the ECB getting ready to cut rates, the Fed not ready to cut rates, and what we're looking for is kind of like the catalyst, right? What's going to be the tell? What's going to be the signal? We're setting the story up with that comment we wrote on Friday. The tell could be ECB cuts, and instead of the euro falling,
it rallies.
It rallies, and that suggests growth. And therefore, and we think then the dollar could roll over quite hard and hit a couple technical levels, and instead of talking about 106 to the dollar in DXY, it could break 1, and therefore break 100. And therefore, that could be significant for us because we're long emerging markets, we're long commodities, and a weak dollar is very supportive of both of those assets.
Lots to unpack there. Let's start with Europe. I'm seeing echoes of that in the Southside research this morning, particularly from JP Morgan and Mislav Matejka. I'll share this quote with you, Jay. We continue to see an improved relative risk-reward for Eurozone equities versus the US, even in the event of further market weakness, and would look to have, as the next step, an upgrade of Eurozone versus the US to an outright overweight. So people are starting to pay attention to this theme. What was it that we learned from the downdraft in the last month about what was happening elsewhere and just how well priced the negativity already is?
Well, certainly when we think about that, we look to China, right? And China has been the epicenter of negativity, right? Uninvestable. We've talked about it on this show before, right? With the pro tip, when you hear uninvestable, you go long. And so China to us is the real opportunity, and we've talked about that through things like KWeb and elsewhere. But when you think about Europe, what's interesting to us is that people always make this mistake. They focus on GDP and not earnings. Stocks move off of earnings, not GDP. If they moved off GDP, China would be the best performing market in the world because it's been the fastest growing economy, and that's absolutely not been the case. So in Europe, you know, companies are doing well. A big part of Europe's equity market actually generates its revenue and profits from outside of Europe. And so to us, the opportunity is in Europe. We're long there. The European banks, John, you and I have gone back for years. They've been massive, but they've been massive outperformers here, massive outperformers. And so you got to recognize that. European banks, Japan, China, emerging markets, you know, to us, there's a lot of opportunity in the world.
Jay, you say go long China, but for how long?
Well, I think China has the best risk reward of any of the markets out there, right? All the negativity is priced in. None of the upside is priced in. KWeb's a perfect example, right? The e-commerce market in China is 2 times the size of the United States. It's growing at 15% per annum. The stocks are trading at a 40% discount to the U.S. equivalents. KWeb could double from 26, now it's 28. When we were on last, it was 25, 28, 250, whatever, and then double again to over 100. The 2021 high for KWeb was $102. It's at 28. It could, as I said, could double and double again. So the upside, I think, is absolutely dramatic.
So US tech firms are having some difficulty at the moment in China. Up until this morning, Tesla was one of those, Apple was another. I want to talk about your original take, I think, on what is happening for Chinese firms in China. You're basically saying they've got the whole market to dominate themselves. Yeah. Is that starting to work?
I love it, John, when you remember it better than I do.
Of course.
It's my story, and you remember it better than me. Thank you very much. I hadn't had a chance to look at my notes. But yes, absolutely right. We call it the 2 tech stack divide, right? basically the US and China are walling off their tech stacks from each other. And people have focused on that as a negative for Chinese stocks because they're not going to be able to participate here. They haven't yet cottoned on to the reality that that means China companies will dominate that e-commerce market we just talked about, which is growing. It's twice as big as the United States, growing at 15% per annum. It's going to be only available to Chinese companies. And Apple is the U.S. poster child of what that means for U.S. companies, because Apple is very dependent on China.
So if it's positive for Chinese firms, is it negative for U.S. firms?
Exactly. There you go. Yes. China is the biggest growth story in the world, in the biggest, fastest growing region of the world, which is Southeast Asia, which China is increasingly moving to kind of dominate economically. U.S. companies are going to have much less of an area of opportunity there.
Mining and commodities, we need to talk about that as well, and copper specifically. So BHP wants a piece of Anglo. We know why, and it's not the diamonds, and we said on the program last week, the new diamonds, it's copper. What does that tell you about the future here in this trade and the amount of copper that we need and how you want to get exposure to this? Through 10K last week on the LME.
Yeah, we've been long copper, very bullish. We've been very bullish commodities. We have a double overweight commodities in our global multi-asset flagship model portfolio, and we play it through COPX, which is the copper ETF, and it's been a monster, and it's breaking out, and I think it will continue to do very well because, look, another theme that we're starting to develop, there's just so much going on, so it's so rich in opportunity to talk about things, is an investment age, right? And one of the ages is AI. Right, you look at the spending, Alphabet and Microsoft last week, right? $45 billion each on AI. The other is on the whole infrastructure in clean energy and renewable and electric vehicles, and that is copper, and that is commodities. And so, to us, that investment age that we see rolling out really supports our kind of multi-year positive view, right? We have a view that 2023 to 2027 is going to be a blue sky global macro period. And this investment build out that we're hearing from companies is really going to underpin that and supports that. So that makes us more bullish, and it makes us want to be long the pick and shovel of AI, which we've talked about, semis, right? And long commodities, physical commodities for the build out. And so it's really semis and copper.
I want to talk about the actual physical picks and shovels. You touched on it just then. And I want to talk about the last 15 years in metals and mining, which you know well, but it's worth going over again. So we come out of GFC, China's booming, so everyone digs a hole, and they keep digging holes. And you give $1 to a miner, it digs the hole deeper. We see that repeatedly. Then comes the bust. We've had some big deals. I was thinking back to Xstrata and Glencore, monster deals. Everything starts to move south. And they become really, really reluctant to invest.
Yes, exactly.
And I remember Jean-Sebastian Jacques over at Rio used to catch up with him often. He's the former CEO. He'd come on the program and he would say, look, now is the time for value over volume. So these guys haven't been building the mines. They've been reluctant to for a long, long time. Are we going to move back into that stage where you give a miner $1, they dig a hole? Or are they actually going to be really reluctant to do so from here?
Well, I think there's going to be some of that, and you're seeing the consolidation first, and then those winners are going to make the decisions on where to put build the hole or dig the hole. But, I mean, to us, it's a supply and demand, right? You're touching on the supply side, right? The supply side is constrained because there hasn't been investment in mining for a decade. And these are not projects that you turn on, as you know very well, right? You don't turn them on in a week.
Yeah.
Years. Takes years from planning to implementation to then providing supply. So that's the supply side. And then you have the demand side, where copper demand and demand for other metals and minerals is growing dramatically, in part because we're reshaping the entire energy system of the globe. And so these two things together, we think are massive. And, you know, you've had interesting shakeouts. So you're talking about the shakeout in the mining, right?
Yeah.
The other side, we're having the shakeout on the clean energy side and the renewable side, right? With the EVs, you touched on Tesla.
It's been ugly.
You know, oh my God, the solar companies, the wind companies, we're in that space because our other model is a thematic model, right? Our TPW20 is thematic. So future tech and climate are the two big drivers there. And that climate segment has been really, really tough the last couple of years, in part because of the interest rate structure, et cetera. So that also could start to pick up pretty significantly at a time when supply is constrained. And we know what happens, right? What brings the two together? Price. And so for us, we think that, 10,000 on copper is not the end of this story.
10K this morning on the LME, up another 0.75%. Jay's going to be sticking with us through the next hour or so. Let's give an update on stories elsewhere. We can do that with your Bloomberg Brief. Let's get to Danny Berger for more. Hey, Danny.
Hey, John. U.S. Secretary of State Anthony Blinken arrived in Saudi Arabia this morning. It's his first stop on another round of visits in the Middle East. In it, the U.S. is expected to push for a truce in Gaza in exchange for the release of hostages. An Israeli official says that if a deal is reached, the country will hold off an invasion of Rafah. Blinken is expected to meet with representatives of Qatar, Egypt, the UAE, and Jordan while in Riyadh, and then he heads to Israel and Jordan. Apple facing more antitrust headwinds in Europe. Now the iPad has been added to a list of products that fall under the EU's Digital Market Act. It means that Apple has 6 months to comply with a whole set of new obligations and prohibitions, things like allowing iPad users to download apps outside of Apple Store. It is a clear loss for Apple, but it also underscores the willingness of EU officials to go after big tech. Saxo told me earlier this morning it's not clear that the sector can outperform now with the growing scrutiny. It's been a tough go for McKinsey employees after the firm cut hundreds of jobs and warned thousands more that the performance needs improvement. But at an event with fellow partners in mid-April, global managing partner Bob Sternfeld said now is a, quote, turn-the-page moment. According to sources, the event was held in Copenhagen, and it was dotted with upbeat declarations. The best part was probably the musical soundtrack. It included songs by Eminem and Bob Marley and Tub Thumping by Chumbawamba. I'm not sure what's more motivational than that, John.
Danny, appreciate it. That we all needed that. Up next on the program, a potential game changer for Tesla. That conversation just around the corner. That stock is higher by almost 10% in the pre-market. From New York this morning. Good morning.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
a potential game changer for Tesla?
I think long term, China, there is definitely a push inside China to pursue national brands. Apple is feeling that, Adidas, Nike is feeling that, and Tesla ultimately will feel that as well. I don't think Tesla will be a top 3 or potentially even a top 4 brand in the future in China. So, but for now, Musk is playing this game in the short run, and let's see how things develop from here.
Here's the latest this morning. Shares of Tesla driving higher as Elon Musk's surprise visit to China appears to pay off. Bloomberg reporting Tesla will partner with Chinese tech giant Baidu for mapping and navigation functions to support its full self-driving. Tesla also passing a key data security and privacy requirement, which could help the company take the software to its cars in the Chinese market. Dan Ives of Wedbush joined us now for more. Dan, I appreciate you jumping on in front of the camera for us to break this down. How big a deal do you think this could be?
It's a watershed moment. I mean, this is 3 years in the making that Tesla has been trying to get into China from an FSD perspective. And this unlocks a golden opportunity, not just for Tesla in China, but I think globally, it's a game changer, in my opinion.
That's what I wanted your view on. Okay, Dan, so China's one thing. What does it mean for the United States and the same thing?
Look, it's important because it's also a shot across the bow, shows what's happening in China, and from a miles run perspective, so from a data perspective, China, that's the golden goose. So this is going to seriously advance Tesla from an FSD perspective, and Musk knew that. That's why he did this trip. It was obviously a surprise one, and I think it's going to come as a surprise in a good way to investors. Long time in the making. It's a trophy case moment for Musk getting back on that plane, come back from Beijing.
Hey, Dan, Jay Pulaski here. Really enjoy your work. When you say game changer and a global game changer, what exactly do you mean? Does this mean the robo-taxi is coming sooner? Does it accelerate that process? I mean, what's really the game-changing nature of this particular move?
Yeah, it's a great question. Autonomous FSD, when you talk about the golden vision, it can't happen without China. So this was a missing piece in the puzzle. The fact that they got this clearance from Beijing, it unlocks really now the whole vision. And I think that's why it's important in terms of the longer term, what Tesla could achieve, not just in China, but globally when it comes to FSD. And I think this is just the start. It's obviously a win for Baidu as well, but it really shows that now finally it's not just talk, it's walking the walk. This is, I think it's a historical moment for Tesla in its FSD efforts.
And Dan, if I could just follow up a little bit on that. We have a thesis at TPW Advisory that it's kind of, we call it a two tech stack world where China and the US are kind of isolating their tech stacks. And that really creates a lot of opportunity within China tech. And I'm wondering how you think about that. And you said this obviously benefits Baidu as well. What about China tech versus US tech?
Look, I think right now U.S. tech's ahead of China. When we talk about AI, I think with Tesla, they're trying to thread the needle here. They're trying to take that technology, even though Baidu, it's stored in Shanghai, to actually be able to use that globally. And I think it just comes down to there's only two companies that have been able to thread the needle in terms of China-U.S. It's Cook and Cupertino, and it's Musk and Tesla. And that's why this is a huge win for Musk, even domestically, for him just to come in there during the auto show, come out, get FSD approval.
So, Dan, let's stress test that a little bit more. Apple, China right now, not even a top 2 smartphone player. Dan, can we get into that a little bit more? What Jay is making, the point that he's making, is that ultimately the Chinese market will be dominated by Chinese brands, potentially in EVs and likewise in smartphones. Why is he wrong?
Because you make the best products in the world, consumers are going to buy them. And that's why at the top of that mountain, the Mount Rushmore, it's Cook and Cupertino. Now, they're clearly going through growth headwinds now, but I believe 6 to 12 months from now, they're not. I think we'll start to see that Thursday when they report. Look, I think this starts betting against Apple in China has been the wrong move. And in our opinion, it's 220 million iPhones there. 130 million have not upgraded in 4+ years. That growth opportunity will be on the horizon.
You say it's the wrong move, but that short's been paid this year. I've said that to you before. We're down 12% year to date, and China's been a big feature of that. You're not alone this morning, Dan, by the way. I'll throw this out there. This came from Bernstein this morning. They say, buy the fear. They say Apple has derated significantly amid a weak iPhone 15 cycle, fears that Apple's China business is structurally impaired. They're taking the other side of it. You mentioned the numbers on Thursday. What are you looking for, Dan?
Look, in near term, John, that's been the right move, right, in terms of the shorts. But it's like betting against Brunson in one game. That's going to be might be a good move for one game. For the long term, it's not. And I think Thursday, it's really about Apple showing that growth as you go into the June quarter, September, what we're seeing in China, that turnaround's there. And this all sets up for AI coming to Cupertino. And that's what I believe is going to really be the massive drum roll over the coming months.
Hey, Dan, it's Jay again. What about the case for AI opportunity in China? Do you look at any of the Chinese companies as you want to pair, like almost like a global pair trade? You have Apple, you have Tesla. Okay, those are the two U.S. companies that are going to have opportunity in China. What about on the Chinese side?
Yeah, I think Alibaba. In my opinion, that's the play in China from a cloud perspective. Everything they're doing, and I think similar to almost like a Microsoft, Google, Amazon, what they're doing on the cloud, I think that's, in our opinion, probably the best China cloud play when we look at Beijing.
Dan, love it. It's great to catch up, sir. No doubt we'll catch up later this week, going into that big earnings report on Thursday. Dan Ives there of Wedbush. So here's the argument that you're making. Chinese market dominated by Chinese firm. Argument that Dan Ives is making is that US firms make the best technology, consumers are going to buy it.
Yep.
Why is he wrong?
Well, I think China's trying to catch up. He's not wrong today, right? Obviously, that's the case. I think the issue is, we're priced for that is one, right? He talked about Alibaba. Alibaba trades at 8 times earnings. 8, okay? Apple, even after the derating, doesn't trade anywhere close to 8 times earnings. So for one, you buy the cheaper version that's going to go up that curve because there's a national policy for Chinese companies to be dominant players in this space. And he has been right about Apple being able to thread the needle in China. I think that area, that opportunity is getting narrower and narrower. And when China feels like it doesn't need Apple to thread that needle, Apple's not going to be able to thread that needle. And so for now, I'm buying the cheap Alibaba play where it has dramatic upside, and thinking that over time, it's going to dominate more and more of that Chinese market.
Jay Pilowski of TPW sticking with us. Coming up on the program, big tech earnings continue this week for two companies with very different fortunes so far this year. Tom Forday of Maxim Group joins us next to preview Apple and Amazon. Equity futures right now on the S&P just about positive by 0.2%. In the bond market, your 10-year yield at 462. And for those of you on dollar yen watch, through 160 and back down again, 155.89.
general advice is continue to seek out companies or people that are maybe 1 stage or 2 stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I played drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
And she said this reminds her of the price action in small caps, the moves on mega cap stocks in America. And Peter Cheer of Academy Securities basically asking a simple question: is 10% the new 1% for mega cap tech? These swings, let's go through them, Jay. I did this earlier, it's worth doing again. So this started with Nvidia 2 Fridays ago on nothing, 10% move lower. Then we start last week, we get Tesla. Numbers come out, we pop 10%, $500 billion name. And then we get numbers from Meta, we drop 10% on a $1 trillion name, $2 trillion name, Google, 10% move on Friday. What's that about?
I think it's people all have the same kind of technical levels that they're watching, and market is really increasingly controlled by algorithmic trading, and so they hit levels, and it's just an air pocket. There's no other side anymore, right? Everybody hits things at the same time, and that's why you have this momentum trade, and people are still confused about really where are we going, you know, with the economy, with the Fed, etc. So it's very much a trend following market, a momentum market, and when that momentum ends, then everybody is like, boom, we're out of here. And so to us, that's great, that's healthy, We don't want things to go to the sky because they never go to the sky. We like pullbacks. And to us, as long-term investors, we really think the opportunity is in things like some of these tech names, particularly the semis, right? Our view is the AI age is real.
Yep.
It's creating an investment age. I mean, the things that I took away from last week was that Google and Microsoft both said they were going to spend $45 billion or more on AI. Okay? That's two companies. That's $90 billion. So to us, the semis are a no-brainer for just buy and hold and ride through these little mini blips. It's not a problem.
They're the picks and shovels. Is
Picks
that right?
and shovels, absolutely.
Okay. You mentioned that a little bit earlier. Let's talk about air pockets and foreign exchange. This one right here. We're talking about levels in FX we haven't seen since the early 1990s. The yen weakening past 160 against the US dollar overnight, then rebounding really strongly. Question, what happened? Dow Jones reporting that financial authorities intervened to support Japan's currency. The country's top currency official saying he had, quote, no comment. Jay Pawlowski, please comment. What's the signal you take from this move?
It's not important, John. It really isn't. Well, look, I mean, the real story is that, here's a question. I'll toss it back to you.
Please do.
What do you think fair value is on the yen?
Absolutely no idea.
Yeah, under 100.
That's what you think fair value is?
Not me. That's what foreign exchange strategists, when you ask them what is the fair value, what is the real effective exchange rate, what should it be, they say under 100. So the dollar yen is at an extreme position. It represents the widest spread in the interest rate world, right? Where Japanese rates are close to zero, U.S. rates are at 5%. So this extreme, in my view, should not be taken as a signal as to where the dollar is or is going. It's a false signal because it reflects the unique characteristics of the Japanese-U.S. relationship on the rate side. It does not translate into the rest of the world. And I think this is setting up something that we're starting to pay attention to, and we talked about it at the open, the potential for the dollar to roll over and have almost a momentum effect, just like we're talking about with tech stocks.
Let's get into that because you mentioned the euro, the single currency earlier. Why is the euro against the US dollar maybe going to be a better example of that in the weeks and months to come?
Well, in part, it's going to be interesting, right? Because the euro, people talk about it should be at parity, should be at parity, should be at parity. And yet it's not at parity. And this is after you've had Germany, the supposed economic engine of Europe, really struggling, right? Europe's very interesting because the growth is in the periphery, not in the core.
That's new.
The growth, exactly. The growth is in Spain, it's in Portugal, it's in Greece, it's in Italy. And so it used to be you'd be really concerned about the rate spread between the Italian bonds and the German bonds. Nobody talks about that anymore because Italy's doing fine. Germany is the sick engine. And yet the euro doesn't want to go to parity. Okay? The euro is fine at 106, 107, 105, fine. And to us, that really suggests that in Europe, the bad news is already in the past. We're moving out of the recession. Germany is actually picking up. And as China continues to improve, the rest of the world improves, Europe will improve as well on the trade side. And they also, like the United States, have full employment. And so full employment means consumption. Consumption means the economy is, not going to go into a big decline. So the euro is likely not going into a big decline. And here's the setup. The setup is that the ECB is going to cut rates in June. And most people would say, oh, that should be euro negative, right? Because it's going to widen that rate differential. Our view is it could be euro positive because it suggests that the central bank is now underwriting the growth recovery. And if that's the case, we would look for the dollar to really take a little bit of a tumble, maybe more than a little bit of a tumble, if that ends up being the case. And so that's what we're watching right now.
107.18 on the euro, that currency pair positive by 0.2%. If you want more data out of Europe, in about 23 minutes' time, we'll get CPI out of Germany. Let's talk about some tech numbers. Earnings continue this week from big tech. Amazon due tomorrow, Apple to follow on Thursday. Amazon stock up this year on the back of strong growth for its web services and demand for its Prime membership. Tom Forey of Maxim Group has a buy rating on the stock, a 218 price target. Joined us now. Tom, let's talk about the numbers from last week and how it informs your view on what we might get from Amazon tomorrow. So we know that cloud spend's pretty solid. Ad spend in places like Meta, regardless of what happened with the stock, pretty decent. Likewise at Google. Tom, does that set the bar a little bit higher for Amazon tomorrow?
It certainly does. So the strength in the cloud computing results from Microsoft, from Google, has me more optimistic on AWS. The challenge for AWS has been you're seeing a lot of enterprise interest in artificial intelligence. This has been the positive. Global macroeconomic weakness has been the negative. So you saw late last year some of the slowest growth you've ever seen from AWS. But yes, Google's comments, Microsoft's comments on their cloud computing revenue have me more optimistic than I was last week heading into those earnings.
Tom, what tells you that they weren't just getting a bigger slice of the pie and taking it from Amazon, that actually overall the pie was getting bigger?
For Microsoft, I do think they are taking share from Amazon. So I do think that partly what you're seeing is that enterprise interest in artificial intelligence is starting to have a positive impact on cloud computing revenue. But I do think that Microsoft is taking share from Amazon, which is a big challenge for Amazon.
Tom, can we talk about another challenge for Amazon? It's e-commerce. What is going on with things like Prime? Typically, for many people, they sign up to Prime and they just hope they can forget about it for the rest of the year if they pay annually. And ultimately, all I'm seeing now every single week is a new charge for an extra something that I used to get for free before. Tom, what is happening with Amazon?
So, all right, so I'm going to spin that very positively. When Andy Jassy took over from Jeff Bezos in July 21, he started implementing his vision for Amazon. His vision for Amazon, as essentially the creator of AWS, is Amazon the services company. So I think what you're seeing here is Amazon's much more interested in selling services to enterprises via cloud, via AWS, to businesses via fulfillment by Amazon, things of that nature. Well, that's higher margin revenue, which could have a positive impact on the multiple and the stock. But unfortunately, as Prime members, I've been a Prime member since the late 90s, you are seeing incremental cost, and it is more expensive to be a Prime member, such as they rolled out advertising now, and if you don't want to see the ads, you have to pay an incremental $2.99 a month. But it's all part of Andy's vision of Amazon as a higher margin services company, which should be good for the stock, but may not be great for Prime members.
Tom, with that in mind, the vision going forward, are we going to have another conversation about maybe spinning it off?
Only if they have to. So when you compare and contrast the antitrust lawsuits for big tech, the good news for Amazon investors is we believe that the sum of parts for Amazon, in the event that they were forced to divest AWS, is greater than the whole where the stock's trading. So I don't think they would do it unless they had to, but the good news is if they had to, it could be accretive for investors.
Tom, can we finish on ad spend? I want to just reflect on last week briefly. Overwhelmingly obsessed with the direction of Meta on any single day, especially with big moves like that off the back of the spend, and everyone will be talking about what's happening with the metaverse, et cetera, et cetera. Underlying numbers were really decent. Ad spend is really solid. You saw that at Google, YouTube, et cetera. Tom, what's happening there? What's supporting those trends, and do you think it's durable through the year ahead?
So the good news for advertisers in general is that it's an election year, so you should have an increase in ad spend because it's a presidential election year. The other good news is you're starting to see the signs in the digital advertising improving, suggesting that the economy is holding up maybe better than expected. So that's good news for digital advertising companies.
Tom, appreciate the update, sir. Thank you. Looking forward to the numbers tomorrow. Tom Forder there of Maxim Group. Looking ahead to Amazon tomorrow, Apple on Thursday. Let's get you some news elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A Paramount takeover deal is hanging in the balance. Sources have told Bloomberg that the Redstone family, which controls a majority of shares, and the independent film producer David Ellison of Skydance are both making concessions and appeals to the company's other investors. Ellison, for his part, is offering to buy a block of Paramount shares at a premium. His bid described as the, quote, best and final offer, as the board remains undecided about a Skydance takeover. CEO Bob Bakish could be ousted as soon as today by a management committee. And the bidding war continues. Blackstone has made a new offer for Hipgnosis Song Fund, this time for nearly $1.6 billion, now surpassing a rival fund's bid. If successful, it means Blackstone will gain access rights to a catalog of artists, including Blondie, Shakira, and the Red Hot Chili Peppers. The board of Hipgnosis supports the new offer. The company's been trying to turn music into something like a mainstream asset class, but higher rates have been slicing into valuations. Major League Baseball plans to address issues with its uniform after complaints from players and fans about changes they made this spring. ESPN reports that the MLB will return to larger lettering on the back of jerseys, fix mismatched gray tops and bottoms, and address the Nike jersey's propensity to collect sweat. In a memo obtained by ESPN, the Players Association said, quote, Nike was innovating something that didn't need to be innovated, but the players will have to wait until the start of next year's season for the new kits. That's your Bloomberg Brief. John.
Danny, thank you. Player complaints. Nike not in a good spot right now, that's for sure. Up next on the program, a second chance in fixed income.
Only 3 months ago, we were answering questions from investors. Did we miss the fixed income rally? And we kind of had to say, yeah, you probably did miss a lot of it, maybe all of it. And investors now are getting a second chance.
The brilliant Chanel Desire, Franklin Templeton, joining us next on the program, counting you down to a Federal Reserve decision on Wednesday and payrolls report this coming Friday. Live from New York, this is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The deal.
That deal.
The deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Wow.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Equities on the S&P 500 higher here, positive by 0.25% through most of this morning. It's a quiet start to a very busy week. Yields are lower by 4 basis points on a 10-year, 462.18. Under surveillance this morning, a second chance in fixed income.
At some point, the market's going to recognize you can't keep rates up here forever. The Fed's going to start to cut, and you're going to have a massive rally. Only 3 months ago, we were answering questions from investors. Did we miss the fixed income rally? And we kind of had to say, yeah, you probably did miss a lot of it, maybe all of it. And investors now are getting a second chance.
Here's the latest this morning. Treasury yields holding steady ahead of Wednesday's Fed decision. Traders pushing back rate cut bets on sticky inflation data and a resilient U.S. economy. Sonal Desire, Franklin Templeton expecting cuts to start in September at the earliest and writing this. I believe this will be a short and shallow rate cutting cycle and expect that 10-year notes will jump around in a 425 to 475 range. After the shallow rate cut cycle is done, we are likely to see long-end yields moving higher due to fiscal pressures. So now let's start the journey with Wednesday, if we can, and great to catch up with you as always. What are you looking for from Chairman Powell in that press conference?
So I think it's going to be the usual. I think, unfortunately, Chairman Powell has a very difficult time sticking with a hawkish tone during the Q&A. So I wouldn't be surprised if in the Q&A, you know, he turned a little bit dovish, left open some roads for rate cuts sooner than I think the Fed probably will cut. But, you know, this is a pretty robust economy. We're looking at a strong labor market. We're looking at decent wage growth. We're looking at decent productivity gains. And the underlying GDP data last week was pretty darn strong. And inflation's sticky. There's very little room for the Fed to be particularly dovish or quick in terms of rate cuts.
At the start of the year, Sonal, as you know, they thought they were on a journey directly towards 2% and maybe cutting interest rates, and the market certainly thought it was going to be set up to cut interest rates maybe as soon as March. And ultimately, we started to get these bumps, and they refer to them as bumps in the road. Do you think they are just bumps in the road, or have they changed course?
I'll just say that if there are bumps on the road, it's a pretty bumpy road, and it's a pretty long one. So, I don't think that these are just bumps in the road. I think what you're seeing is genuine stickiness in inflation, and it's coming from a lot of misreading, I think, of what went on in the post-COVID period, where everyone assumed that, the economy had fallen over and gone to sleep for an extended period, and it hadn't. And there was so much of fiscal expansion during that period, and we continue to see the impact even today. I think it's going to be a long time before we start seeing inflation going all the way back to 2, certainly not this year.
Sonia, Jay Pawlowski here. We were talking earlier before we went live about why one should own bonds or buy bonds, and we're very underweight treasuries here at TPW Advisory. You talked about strong growth. That's the reason why we're very underweight. Strong growth is not really constructive for treasuries. So I'm curious, what would be the case, if you could make the case for buying bonds here at these levels, or what level would you suggest people should get long bonds?
But I think it's very fair. What you're saying is definitely a fair point. On the other hand, I would say that most institutional investors, retail investors are massively underweight bonds. I'm not suggesting going massively long here. We were short and we did go neutral over the last several months, and we're slightly long right now. But I would say that that range that I'm talking about, in anticipation of a rate cutting cycle, albeit shallow, and I don't anticipate that this is going to be the rally to end all rallies, I see some point in actually diversifying. Fixed income ideally plays a diversification role in portfolios, and I think that's really the case to be made to hold treasuries. When I talk about it being shallow, the reason is I think over the longer term, it is inevitable almost that we see treasuries moving systematically higher for a while. So we might see them come down, and I don't expect them to rally all the way down to 2%. I don't expect the Fed cuts to take us to 2%, and certainly treasuries aren't going to rally anywhere close to what we've seen in the last 15 years. But then we will start seeing the sell-off which comes from the fiscal pressures, which is going to go on for several years, I would anticipate. So it's a period. It's a short cutting cycle. I think that's really important to think about.
Yeah, and I would agree with that completely, Sonia. What about credit versus treasuries? And then could you just touch on that fiscal pressure? Because you're absolutely correct. People have very much underestimated the power of the fiscal side of things because we've been so used to monetary policy driving everything since the great financial crisis. So help me understand the view between credit in the U.S. or globally versus treasuries, and then this idea of fiscal. How much of a window do we have between a rally in bonds before that fiscal pressure really manifests?
So I'd say that the first bit on credit, the reality is all-in credit yields will still give you, if you're talking about high yield, 7.5%. And so you can find pockets of value there. The all-in yield is somewhat attractive, and I can see that. In spread terms, we're looking at pretty tight spreads. Again, the case can be made reasonably, and I'm sure you would make this one, that we're looking at corporates which are in better financial health than they have been historically. So I accept all that. And I think that credit definitely has a space in portfolios, despite how tight it is from an all-in perspective, there is room for some credit in portfolios, I'd say. The second point that you were making, which is when does the fiscal axe fall? We have begun to see it, and we periodically see it when the market focuses on the fact that we're looking at 6% plus 6% of GDP plus deficits in a forward-looking way, and this is probably conservative in the event that we have a split Congress at the end of the next set of elections, in the sense that it doesn't matter who wins, right? As long as you have a split Congress, you're unlikely to see much fiscal consolidation. That, I think, is an important factor. I don't think it happens certainly not this year. We're going to see a lot of fiscal spending. That's a given this year. But I think you would continue to see that. When does that really drop, that axe? I think we're going to need to see more of a buyer strike. And as we see long-end yields move higher and higher, I think the U.S. will be forced to do a certain amount of fiscal consolidation. But until we see that, I don't see that consolidation happening, and Treasury yields absolutely can go higher than 5% in that scenario.
Do you think that's a challenge to Treasuries as a diversifier, Sonal? If you think about where the deficit is now, that's going to gap out if we go into an economic downturn, and typically that's when you would buy Treasuries. Is that going to be a challenge to that?
I think there is a challenge to that. I think right now, the growth of the economy is something that we all have to be really grateful for, because right now there aren't that many silver bullets, certainly not on fiscal, and very few on the monetary side. So it's the fact that the economy continues to grow is the one somewhat saving grace here, though the fact that it continues to grow also indicates very clearly that neither fiscal or monetary policy are particularly tight.
Yeah, Sonal, thank you. Big questions for the news conference for Chairman Powell later this week. Sonal Desai there of Franklin Templeton. What did you make of that point there?
Yeah, very solid. I mean, that was a really well-reasoned argument, I think, about how to think about things, not with, black and white, but nuanced.
The fiscal pressure specifically, though, Jay, is that something that concerns you?
Fiscal's been a real boost to the economy. It's been a real support. It's helped that U.S. exceptionalism that we talked about earlier. Going forward, I think it becomes a little bit of a challenge, particularly on the fixed income side. And therefore, those are some of the things that really strike us, right? I mean, the IMF meetings last week, we touched on them a couple weeks ago, right? 82% of those surveyed expect a stronger dollar, right? What we're talking about here, fiscal pressures, the U.S. buyers strike, I mean, it could really kind of get going on itself a little bit where the dollar goes the other way. And it's set up to do that based on the fact that speculators have the biggest net long position in the last 5 years. So there's something to that, I think.
A major question then as Treasuries as a diversifier. Can you just walk us through in the next 30 seconds, if you can? What's your diversifier? What works?
Yeah, well, the diversifier right now has been commodities, right? Commodities have had a negative correlation with the S&P. They've sailed through this little mini correction very healthily. Our benchmark is ACWI, Ag, and Goldman Sachs Commodity, 50-40-10. So we have an overweight in equities, we have an overweight in commodities, we have an underweight in treasuries because we are pro-growth. And so being pro-growth, we don't see the case for treasuries. We want to hedge out that risk exposure.
Jay, this was awesome. Let's do it again soon.
Absolutely, John.
Good to see you. Thank you, buddy.
Marie, hopefully you'll be able to speak next time.
The voice returns.
We missed you.
In the next couple of days. Jay Pawlowski at TPW Advisory. Thank you, sir. Coming up next, Sarah Hunt of Alpine Saxon & Woods, Mandeep Singh of Bloomberg Intelligence, Stephanie Roth of Wolf Research, and Bloomberg's Ed Ludlow. Big week ahead from New York. This is Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Season 2 of The Circuit. We're walking with the titans of banking.
You guys love these mean
Yes,
things.
we do. And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money. You've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging on for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
Inflation is not coming down as fast as we expected.
Inflation just has stopped going down. It's stalled at a level that's uncomfortable for the Fed.
They're going to want to be more patient. Inflation is going to be top of mind.
I think the clear part of the new narrative is high for long on rates. The question is, where does that take us?
You can't keep rates up here forever. The Fed's going to start to cut, and you're going to have a massive rally.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Fantastic start to the week so far. Live from New York City. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now. Already this morning, Jay Pilosky of TPW talking about peak U.S. exceptionalism. We caught up with Laurie Calvasina of RBC, who reflected on mega-cap tech stocks behaving like small caps. We'll talk more about that through the week, no doubt. We have a monster week ahead for you. And it looks a little something like this. Tomorrow, after the closing bell, numbers from Amazon. On to Wednesday, you'll hear from Chairman Powell in that news conference at 2:30 Eastern Time. The Fed decision, 2 p.m. in the middle of this week. Thursday, numbers from Apple. Very challenged stock so far this year, down by about 12%. Challenge in China. Then on to payrolls Friday. The estimate in our survey, a sneak peek for you, 250K. The bond market going into all of that set up like this. A 2-year, 10-year, 30-year. Looks like the following. Very close to 5% on a 2-year at 497. We're down 2 basis points on the session, up more than 30 on the month so far. On the 10-year, down 5 basis points on the session, up by 40-something in April at the moment. 461.56 on a US 10-year. Coming up this hour to discuss some of the big themes, we'll catch up with Sarah Hunt of Alpine Saxon Woods, following the best week of gains on the S&P 500 so far this year. We'll speak to Stephanie Roth of Wolf Research, looking ahead to the Fed decision, and Bloomberg's Ed Ludlow previewing Amazon and Apple earnings. We begin with our top story, stocks rallying on earnings optimism ahead of the Fed's 2-day meeting. Sarah Hunt of Alpine Saxon Woods saying this: there are plenty of unknowns in 2024. The market may end up more dependent on earnings than usual. If earnings can live up to or exceed expectations, that may not be a bad thing. Sarah joins us now for more for the hour. Sarah, good morning to you.
Good morning.
Let's get to those earnings. You say earnings season saved by just 2 names last week. Is that it?
Well,
It's more the theme, right? So the two names really are the ones that most encapsulate the theme of AI. They needed to show that there was big growth there, they needed to show that there was profitability there, and they needed to show that there was a lot more investment there. All of those things happened. You could even add Meta to that, because even though there was some disappointment on some of the CapEx that wasn't AI related, I think the fact that they're talking about spending so much more money there is really important. And I think that had that not occurred, this is sort of what the market was hanging on. And you had a huge rally from September of last year, or October of last year into this year, and then a huge rally in the first quarter. And if you didn't see that come through, I think there would have been a lot more vulnerability than we're seeing. I mean, you certainly saw it before earnings started.
We reflected on this last week. We should probably do it again. Meta spends a lot, and the stock got punished. Alphabet and Microsoft did something similar and got rewarded. What was the big difference for you?
The big difference is that the question of what Meta is spending on, because the AI spend I don't think was the problem. I think it was going back to those Meta labs and how much money is being spent there, and whether or not the discipline that Meta got when the stock had a real problem a couple of years ago and said, no, we're going to focus our spending in these ways and we're going to stop spending so much on what is more speculative but we think is the future. I think there's creeping back in. So I think that that was a little bit, and where the stock was too.
Mike Wilson of Morgan Stanley was with us last week, and he was very keen to point out, of course, the usual, which is the data is one thing, how the stock responds to that data is just as, in fact, it's more important. What did you take away from these big double-digit moves on Uber cap tech names? 10% in either direction. Peter Shea of Academy, I've said this repeatedly through this morning, is 10% the new 1% for some of these tech firms, and you anticipated more of the same this week?
So I think that there are some one-off reasons why those stocks moved so much. And part of it was that the tech stocks had actually come off the most in April. And the first quarter wasn't as strong as the back half of 2024 for some of those tech stocks. And I think it was a huge relief, because the concern was, if this doesn't go the way that it is supposed to, these stocks are expensive. And can their earnings grow into their multiples, right? Because there's a whole lot of conversations about multiples. And why isn't, even though stocks have surprised to the upside, why aren't stocks moving higher? Well, those earnings needed to be there because those multiples had already moved. So I think that that's a lot of where you were. And I think for those two in particular, it was just relief. And it was like, well, this is great because you're seeing big growth, and growth is what's really important for these stocks.
You say earnings season has been saved. What are you expecting now? Are you anticipating Apple and Amazon to continue saving the earnings season?
Well, I think that for Apple, there's more one-off issues, right? You've got the China issue, you've got some current concerns. I don't think longer term there's a problem for Apple, but I think shorter term, there's a reason the stock has not performed as well as the other ones. Amazon is also a little bit, let's see if AWS can grow as much as you did see the cloud grow for Microsoft and for Alphabet. And AMD is this week too. You know, we want to see what the semiconductors have to say. There's still a lot to go, but I think that those two giant bellwethers, if it had gone poorly, it would have been a problem. Now, saved forever, I don't know, but certainly, like, the beginning of April was not pretty, and we certainly saw that reverse a little bit last week.
What's your read so far on the international cyclical story and the challenge from places like China, the challenge particularly for a multinational that's based here in the United States that has to have that stronger dollar translated back in from that foreign currency? What's happening there? How big a challenge is that?
Well, it certainly depends on the company, and it certainly depends on the country. I mean, you've been talking all morning about the Japan versus U.S. currency. There's been a lot of other less severe movements in other currencies, and I think that, you know, we're still trying to grapple with how we came out of this pandemic, right? Like, there's still not the normal playbook of X happens, Y happens, recession happens, this happens. That just hasn't been what's occurred. So we're still trying to figure out exactly what that means and how to work with it.
Can we tease that out a little bit more? Because I think you're onto something really important. When we come out of GFC, we were always looking for the Federal Reserve to hike interest rates. We had a lack of understanding about the current cycle, so just anticipated a return to the previous one. And it was false dawn after false dawn waiting for those rate hikes. They just never came. You had to wait until 2015 for them. And then you had to wait another 12 months to get another one after that. Do you think that's what's going on now? There's just a lack of appreciation for where we are currently, so we sort of gravitate towards what it used to look like pre-2020.
Well, this is the whole question of where interest rates are going to go. Are we renormalizing to pre-financial crisis levels, or are we just normalizing and then we're going to go back to the low interest rates post the financial crisis? If you think that we're normalizing to pre-financial crisis levels, 5% is not insane. And it's also not so high that people can't manage it. It was the speed that people were concerned about, and rightly so. It did catch up some banks, and there's still some questions about commercial real estate. There's plenty of unknowns and plenty of questions and things that you can get really worried about. But the truth of the matter is 5% on the 10-year or 467 is not insane. And if we think about more normalizing, the idea that we're going to cut all the way back to 2 or all the way, to some much lower number, you have to wonder whether or not you cut back to at some point, but not to some level that's more post-financial crisis than pre-financial crisis.
You mentioned we're not out of the pandemic era yet. When do you think we would know when we're out of it?
That's an outstanding question for which I do not have an answer. I think that you start to see things react more like you expected them to pre-finance, like the playbooks start to work again, and the things that are normally correlated correlate again, because we have such odd correlations, and we have so many things. All these things move together when they don't usually, in positive or negative. I think when you start to see some of those historical relationships, if you keep interest rates in what is considered a more historical level, those relationships start to reignite. Then I think you can say, okay, we have finally started looking at that. But I mean, what is that going to look like for commercial real estate, for office? I don't know, because we're working 3 days a week in the office and 2 days at home. I think that there are some things that are going to stay, and that's a longer term prospect to how that sorts itself out.
Just for the record, we're working 5. We're very happy about it. Very happy about it. So let's talk about sectors. We started this month with this big hope about a rotation. Saw a lot of that in the month of March. Then it's faded and faded so rapidly. In fact, hardly any guest even brings that up on this program anymore. Going into small caps, looking elsewhere beyond big cap tech, particularly after last week. Where are we now with that question?
I think that it's bad. You have to have some sort of a balance, right? Because last year it was all about big tech, and that's all that worked. This year there are more things that are other things that are working as well. But when big tech reasserts itself, people start to go right back to it. It's the huge amount of cash flows. I think balance sheets are going to matter. Sectors matter, but balance sheets are going to matter. Utilities are the new hot sector because of the fact that data centers and AI need so much electricity. So there will be ways that this broadens out. But in terms of a wholesale shift away from technology, it's difficult for me to see why that would be sustainable, just because the cash generation is so insanely huge, and that's really important, and the growth is still there. The growth hasn't gone away from that. So it's about broadening out and adding to as opposed to switching from.
Let's talk about the financials. Banks have had a pretty decent run. If I think about what's performed well relative to how much it's talked about, this is hardly talked about. The fact that we've got JP Morgan up this year by 14%, Goldman up double digits, Citi up 21, big turnaround story there with Jane Fraser, Bank of America up by double digits, even Deutsche Bank up by 24%. What's supporting some of those banks at the moment?
Well, I think that some of it was a catch-up trade. I mean, these stocks had been absolutely brutalized. Even though things were going okay, the idea was if we're going to cut rates, it's going to be better for banks, and that's great. And then that story started to fade, and the banks just started to really not perform enormously well. European banks have been under scrutiny for a long time, so it's a little bit of a bounce back. And hey, if Europe is going to be okay, then the banking sector should be okay. And these stocks are really cheap. In the U.S., they were also less expensive, but you've also had a consolidation. So the bigger banks are doing better, and the smaller banks, the regional banks, are still struggling. And I think that that's just going to continue. It's sort of like the story of the mega caps, not just in tech, but across the sectors.
Sarah Hunt is going to be sticking with us for the hour. I wanted to bring you this note from Mislav Matejka at JP Morgan on Europe versus the United States. I mentioned this earlier this morning. Interests me. I'm not sure if you're all aware of this. We don't expect Eurozone to directionally decouple from the US, but it's interesting that in the recent bout of market weakness, the S&P was down 5 to 6%, in contrast to the Euro Stoxx 50, which was down only 3%. Here's the quote, the important one. We continue to see an improved relative risk reward for Eurozone equities versus the US, even in the event of further market weakness, and will look to have, as the next step, an upgrade of Eurozone versus the US to an outright overweight. People getting more constructive on the European story relative to what's in the price, relative to what's expected here in the United States. And those comments echoed by Jay Pulaski of TPW in the last hour as well. Equities this morning on the S&P positive by 0.25%. Sarah's going to be with us for the hour, I'm pleased to say. Let's give you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. U.S. Secretary of State Anthony Blinken has arrived in Saudi Arabia. It's the first stop in another visit to the Middle East. The U.S. is expected to push for a truce in Gaza in exchange for the release of hostages. An Israeli official says that if a deal is reached, the country has agreed to hold off from an invasion of Rafah. Blinken on his trip is expected to meet with representatives of Qatar, Egypt, the UAE, and Jordan, all while in Riyadh. Then he heads to Israel and Jordan. China's President Xi will visit the EU for the first time in 5 years. Next week, Xi will visit France and Hungary, as well as non-member Serbia. There are heightened tensions with the EU at the moment over a number of issues, from trade to spying allegations. EU members have also knocked Beijing for supporting Russia's invasion of Ukraine. China, for its part, is pushing to repair relations with the EU. Leaders there have become more assertive in responding to China's trade policies. And Spotify CEO Daniel Ek is cashing in on big gains from the stock's rebound. He filed to sell about $120 million worth of shares. Spotify is on the back of its biggest gain of almost 2 years. It swung to a profit in the first quarter. It does appear to be the year of taking profits for tech billionaires, thanks to a neat run-up in the sector. Michael Dell, Jeff Bezos, Mark Zuckerberg, all of them have cut stakes in the companies they founded over the past few months. That's your brief, John.
Danny, thank you very much. Appreciate it. More from Danny Berger in about 30 minutes' time. Equities doing okay, up 0.25%. Some big moves in the Japanese yen overnight. We'll update you on those in just a moment. Up next on the program, regulators taking another bite out of Apple.
It's easier for Europe to do a lot of regulation, where in the US, the technology sector plays a crucial role for economic growth. I'm not so sure, actually, that the technology mega caps will continue to be an outperforming force in the market going forward. I think the tide is turning a little bit here.
Mandeep Singh of Bloomberg Intelligence weighing in on this story and looking ahead to the numbers from Amazon and Apple later this week. That conversation on the other side, live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Equities on the S&P 500 doing okay. Starting there on the S&P at the moment, we're positive by 0.25%, a little bit of a lift following a big week of gains last week, the biggest weekly gain on the S&P 500 of the year so far. You'll hear lots about that, less about the fact that it followed the biggest weekly loss of the year so far on the S&P. And in April, we're still down about 3%, the worst month going all the way back to September. Remember, this rally has been a rip-roaring one since the end of October. Yields are lower by 4 basis points on a 10-year, 461.97. The big story in foreign exchange is this one right here. If you are just tuning in, welcome and looking forward to spending the week with you. This move in the Japanese yen is the one we're all talking about. Through 160 for the first time since the early 1990s, gapping a lot lower off the back of that, all the way back down to as low as 154.54. At the moment, about 156. Plenty of speculation about so-called yen intervention. You get it? Yeah, okay. So-called intervention from Japanese authorities. They haven't said they have. They haven't denied it either. They're just saying no comment. Dow Jones says they have, based on their sources. Japan's financial authorities did intervene in the FX market overnight. So that's where we are. That currency pair negative 1.2%, a stronger Japanese yen after a much, much weaker one overnight and through the month so far. Under surveillance this morning, regulators taking another bite out of Apple.
It's easier for Europe to do a lot of regulation, where in the US, the technology sector plays a crucial role for economic growth. It creates a more difficult and less opportunistic environment, but I think US technology companies will still continue to thrive. It's just a different environment going forward. There's just a lot of scrutiny going forward. I'm not so sure actually that the technology mega cap will continue to be an outperforming force in the market going forward. I think the tide is turning a little bit here.
So here's the latest. EU regulators giving Apple 6 months to ensure the iPad's ecosystem complies with the new Digital Markets Act. Despite the crackdown, Bernstein recommending investors, quote, buy the fear, upgrading shares to outperform with China concerns, they say, which are overdone. Their stock is up by 2.5% at the pre-market, ahead of earnings on Thursday. Mandeep Singh of Bloomberg Intelligence joins us around the table. Mandeep, let's start there. What are you looking for from this big giant on Thursday?
Well, I mean, to me, Apple is always about the iPhone shipments and the services revenue more and more, given, that's the high margin revenue stream. But in this case, everyone seems to think Apple China issues are overdone. To me, what really stands out is how well Huawei has done in terms of developing an alternative and how well that phone is doing. So as long as there's no alternative to the phone, we could argue, it's a very sticky product. People have to refresh. There's no choice. But now there is an option in China. And I think that's what stands out.
Can we get into that word overdone? Overdone because it's not as bad as everyone thinks it is in China, or overdone because it's so well priced so far this year?
Well, I think, again, the 20% revenue stream that you have to kind of model how much are they going to lose that share over the next 2 to 3 years. Previously, people were modeling maybe they will lose like 1 percentage point of share. Now we are talking about the revenue even disappearing over the next 5 years. So that's a totally different assumption. And if that plays out, then clearly that's not reflected in the stock.
So when you say disappearing over the next 5 years, are you talking about the market moving so far away from Apple that they're really not selling very much in China at all?
Yeah, and they have to obviously shift their supply chain. So that's the cost side of the equation. But in terms of the revenue hit, now we are talking about tangible competition that can actually take share. Previously, that wasn't the case. And I'm not even bringing in the AI aspect that, it has got more AI features like the Android ecosystem. It's just the fact that they have a domestic phone that's comparable in terms of features. That's a big deal.
Mandeep, how much is this driven by policy coming from Beijing versus actually demand in China?
Well, so again, I think it's hard to separate the two simply because there is an outsized influence in terms of what goes on, with the people's preferences in the region and how the government does have an influence. So clearly, whatever the government did with the, preventing the government employees from accessing the iPhone did have a bearing in terms of that early step. And now we're seeing that trickle down to the consumer. So to my mind, as long as, they can provide all the features and that experience on the phone that everyone is looking for, people will migrate because that's coming from the government. And then, they provide the infrastructure, the towers and everything, and they can make sure the domestic phones function better.
So that could be a bigger problem than I think anyone is really anticipating. I also wonder from the consumer standpoint, if you're going to see that much switching just because of the brand consciousness and whether or not, what kind of analysis is going on right now in China about how Huawei is positioned and how people perceive it, because there's a luxury aspect to Apple. So the idea that it would go away completely, I could understand on the functionality if the functionality was somewhat less practical, but it's a little bit a lot to think that that could just go away entirely again, given the sort of the brand aspect of Apple and what that stands for.
You're right. There is a luxury aspect, and people in China still buy the Louis Vuitton bags there, with all the preferences they have. So there is that aspect. But look, in terms of the phone, it's about the features and the data. The biggest lock-in that Apple had was it was very hard to move the data out of the iOS ecosystem. Now, if people are switching, they're moving to Huawei phones.
Yeah.
Yes, maybe that problem is solved. And that's where, the stickiness suddenly gets questionable. Okay.
That's what I want to get into. Can you talk to us about how that stickiness has been reduced in China because the way they regulate the ecosystem and what China's allowed to do is so different compared to, say, the US and Europe. Can you go through the differences for us?
Yeah, I mean, what we are seeing with Digital Markets Act is an example of that, where they're saying the gatekeeper companies shouldn't have an undue advantage with the default apps, shouldn't just lock in their customers by virtue of holding all their data and not letting that data move out of the ecosystem.
And that's already the case in China?
That's already the case in China. I mean, that's what they have implemented. They've basically made sure the App Stores complies with their set of rules. And in their set of rules, I mean, if you have to operate there, then you have to let all these things happen.
So what argument will Apple have as the EU tries to do the same thing?
I mean, they are complying. It's just Apple's pitch has always been, when you come to the Apple marketplace, you get access to the most consumers. So if you're a company, a new app developer who wants maximum access, then you have to come to the Apple App Store as opposed to going to an alternative app store. Even if it charges less, you're not going to get those, 500 million plus users that you are going to get in the Apple App Store.
Will the data security risks argument work?
I think that's what's going to slow this thing down, that even if you have an alternative app store, the fact that if you download an app, it's going to expose your operating system and your data, why would you do that as a consumer? And so that is a very powerful argument, but the companies that are offering the alternative app stores have to make sure, they really they kind of bring that offering that consumers are convinced. So if it's a like of, let's say, Netflix or an Amazon that is offering their alternative app store, then maybe it's a powerful argument to say this is safe enough for me to download an app and keep using that app store because I can save on that commission.
I think this is going to end up being one of those things where experience is going to teach us what's going to happen, because it sounds like there's a lot of possibilities and there's a lot of reasons why you could say, yes, that works, but it sort of reminds me of economics in general, which is here's a bunch of data sets and we're going to ignore all the other stuff and see how that plays out. But it does sound like there's more threat there than I think the marketplace is appreciating, at least at the moment.
And the payments aspect. So I think the fact that they will have a lot more alternative forms of payments, everybody as a developer would try to save on that 3% payment cost if you can get it lower, because Apple does have to allow alternative payment systems now. So I think that is the easy substitution that developers will look to make.
So Mandeep, 2 more Mac 7 names to come this week. The final Mac 7 name at the end of May, I think on the 22nd, right, for NVIDIA. What's the big takeaway so far? We've heard from the likes of Meta, Alphabet, Microsoft, Tesla. What's the big takeaway for you?
I mean, CapEx is going up, and it will go towards buying NVIDIA's chips. So clearly there is that insatiable demand, and everyone called out the supply constraints. Even Microsoft said they're supply constraints. So if a company with that kind of CapEx budget is saying they're supply constrained, that tells you something.
Do you think the bar for NVIDIA just got a little bit higher then over the last week?
It has, and it's reflected in that run-up in the stock over the last week. So I think, again, as I said previously in your show, the next 2 quarters does look good for NVIDIA in terms of the demand and, them coming out, beating and raising. But it's always about tougher comps. What do you do after you, are past these comps? And I think it's a tougher bar as they continue to go along.
They're just in the business over the last few years of just beat and raise, beat and raise, beat and raise, beat and raise. Mandeep, this was awesome, as always. Mandeep Singh there of Bloomberg Intelligence. You will see plenty more of Mandeep through this week. We'll get numbers from Amazon tomorrow, Apple on Thursday, towards the end of May. May kicks off in 2 days. Unreal. Towards the end of May, you will hear from NVIDIA. This just in from Goldman Sachs. Their view for Friday, payrolls, 275K is the estimate. The median's 250. This is really punchy stuff going into Friday. Much more still to come. We'll catch up with Stephanie Roth of Wolfe Research, looking ahead to the Fed on Wednesday and payrolls to round out the week. Live from New York. Good morning.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
The curve on the month, up by more than 40 through the month of April on a 10-year maturity. We're down by 3 on the session to 462.80 on a 2-year to 497.67. Talked lots about payrolls. We'll do more of that in just a moment. But the median estimate in our survey at the moment, 250,000, which is still pretty punchy stuff considering at the start of the year, everyone was looking for a recession and they were looking for rate cuts to start by March. Yeah, okay, that didn't happen. Turn to this board in foreign exchange. Big moves here too. Coming into the month, worried about 152. You got 160 overnight on dollar yen, 156.39. Gapping higher, then gapping lower. Big move lower, negative by 1.2% on the session now. So that's a stronger Japanese yen and plenty of speculation, as you might expect, on whether there was or wasn't intervention. Based on the Ministry of Finance, which has control over this situation, I do not put any emphasis on the word control whatsoever. They said no comment. Dow Jones said that there was intervention based on their sources overnight. Is it sustainable? That's your judgment call. At the moment, that currency pair is 156.34. Under surveillance this morning, a Paramount takeover deal hanging in the balance. The CEO, Bob Bakish, could be replaced as soon as today as the Redstone family and independent film producer David Ellison of Skydance appeal to other investors. Ellison is proposing to buy a block of shares at a premium. The Redstones agreeing to let non-voting shareholders approve any possible transaction. Sources telling Bloomberg that Skydance's bid is considered the best and final offer. AMH, talk about a mess. This stock is up in a pre-market by 5%.
Also, we should note that Ellison is not just a producer, but it's Larry Ellison's son, probably why he has the capital to buy some of those shares, that block, for a premium price. And it does look like, given that, potentially this deal could go through. Although the market is interesting that the shares are rising, they're going to get rid of the CEO. And Jonathan, this is what one report has out of Barron's. And, quote, Office of the CEO unit all the divisions head would then start running the company.
There's been a fair bit of investor pushback around this story as well. That stock is higher by 5%. Look out for more headlines on that. A little bit later, no doubt Ed Ludlow and Caroline Hyde will pick up that story on Bloomberg Technology later on today as well. We'll catch up with Ed in about 15 minutes' time ahead of their program. The Tesla CEO, Elon Musk, securing a crucial partnership during a surprise visit to China this weekend. Bloomberg reporting that Tesla will use Chinese tech giant Baidu's mapping and navigation functions to support self-driving. The partnership helping Tesla to clear two key hurdles in the world's biggest auto market. Tesla also passing a key data security requirement. Their stock is up now. Look at this, up by more than 12% in the pre-market. Sarah Hunt's been with us for the last 30 minutes. She's with us for the next 30 as well. We were having this conversation this morning with Jay Pawlowski of TPW, and Jay made the point about Chinese brands dominating the market in China and foreign firms struggling. And Tesla is one of those companies we're talking about. It's up this morning. Where do you see the ability of US firms to compete in the Chinese market effectively? How difficult is that going to be?
I think it's quite difficult, especially with what we've just been talking about with Apple and Huawei. But I also think that what this demonstrates is that Elon Musk saw an opportunity to go in there and say, look, I want to do this, because you've seen the clashes that have been going on between the U.S. and China. He's trying to put a foot in both sides and say, look, I've got this technology. And he had the premium brand in China, and then all of a sudden the EVs in China started to get less expensive, and Tesla started to lose share, and he had to drop prices. So to me, this is a way to say, I'm going to change up this math for myself, but also if I can be successful in this, then maybe I get to be the outlier.
Do you think there are some CEOs that are better at this than others? I'm thinking Tim Cook, Elon Musk. Are there certain CEOs of American firms that can play the China story just a little bit more delicately, diplomatically?
Well, you would hope that you could for Apple, because they make so much product there, right? But I think that what Musk is doing is quite smart, and he's going in there and saying, look, I can bring you this functionality that you don't have, and I can use Chinese technology to do it. And I think that that is one of those, he's the consummate salesman. He's been able to explain to people, I can do this, I can do that. Even with what's going on with the numbers, which weren't that great, I'm going to bring a lower price car, it's going to be fine. And I think a lot of people were short Tesla. I think a lot of people were worried about Tesla. And I think what he's done is he's just thrown a whole bunch of more information at you and said, this is all going to be great, and let's hope that the numbers can prove it out.
If you were short overnight, you're getting squeezed now in the pre-market, up by double digits. Elsewhere, investors looking ahead to a busy week. On top of tech earnings, the Fed's two-day policy meeting starts tomorrow. With a rate decision coming Wednesday afternoon, Fed Chair Jay Powell expected to hold rates steady. Bloomberg Economics anticipating more hawkish rhetoric as US data continues to run hot. We'll round out the week with payrolls on Friday. Stephanie Roth of Wolfe Research, looking ahead to those two big events, joins us around the table. Stephanie, good morning to you.
Good morning.
Can we start with payrolls and skip the Fed just for a moment?
Sure.
250, median estimate. Are you looking for a punchy number as well?
We are looking for a punchy number. We're looking for 270, but we're looking for a softer average hourly earnings number, which is arguably more important in this environment.
Supply side story.
Supply side story.
How much immigration are we getting?
We're getting a lot. I mean, if you look at the CBO's numbers versus where they were a year ago, it's about 1.5 to 2 million more people per year than they previously expected. And this is why we're talking about 250 type numbers, and we're not that scared of it.
Which is such an interesting combination with the fact that we're looking for higher inflation in that people are spending money, but our wages going up so much because we've got this influx of people. And I think that that's where it's a tough thing from an economic standpoint, because the wages can't move up as fast if I have plenty of labor supply. So people are getting hired, but are they getting hired at high enough wages to deal with the fact that goods have essentially, and food and things have shifted up in terms of pricing? Those levels haven't come down, even if inflation is slowish.
So, I mean, I think when you look at from the start of the pandemic, you look at prices of most goods, core inflation, they're up kind of in line with where wages are so far. So consumers can generally afford what they're paying. They just don't feel great about it, which is why consumer spending has held up fairly well. If that wasn't the case, then you would have seen a demand destruction type of environment, but that hasn't been the case. We've seen a resilient consumer because they've been frankly able to afford it on average. It's just they don't feel great about it. Now, looking ahead, we should see core inflation, and now we're seeing core inflation running at something like 3%. It's not as if it was anything like what we saw. And the consumer's still in pretty good shape. We saw that on Friday. That was one of the bigger expectations of the savings rate falling back down to 3.2%.
Well, that was going to be my next question, which is the savings rate has come down and credit card balances are going up. So when people can afford it, but are they putting themselves in a financial position that's more precarious than they were? You had this whole period of time during the pandemic where everybody built up their household balance sheets. Are we going back to a point where it's expensive? I mean, you just think about the rates on credit cards right now. You're carrying a credit card balance, that's all of a sudden you're paying 21% on that.
So when you look at consumer borrowing overall, it actually is kind of steady, similar to where we were from a growth perspective in the last cycle. Credit card balances have risen slightly higher than average, but not that materially. So it's not really being driven by credit. It's a combination of, we still have this excess cash, which there's been a lot of revision to the estimate, but the excess cash is still kind of there. Nominal income growth is really strong because we have strong wage growth, strong employment growth. So the consumer is able to sort of spend because of things that are kind of combination of income growth, some excess cash. So it's been an environment that's not really being driven by leverage.
Last jobs report, though, we saw the percentage of people who had to go out and get a second job or even a third job to support that spending, that was up. Do you expect more people are doing that?
There's probably an element of that, but I think it's more driven by sort of domestic labor force growth from combination of these new people. From an immigration perspective, we've estimated that it adds about 20 basis points to consumer spending over the past 2 years, which is decent, but it's not monumental either.
So take me to Wednesday. Let's take the data and push it through Wednesday. We've been talking about how confident Chairman Powell is for the last 4 months. He needed some more confidence. He's clearly lost some confidence. How much confidence should he take by that story you're telling in the labor market?
I think he believes it deep down, but I don't think he can rely on it at this point. I think after the third, and he was the last one of the big Fed speakers to come out and say, okay, fine, we've kind of lost confidence, and by March we're not feeling great about the data. Our base case is you'll start to see the inflation data start to soften in the next couple of months, and then there might be some restoration of the confidence, but he's not going to be able to communicate that on Wednesday. It's going to be probably a fairly hawkish press conference.
Isn't it at least better for him that there's growth that's coming through this, that he's not in a position where the inflation is high and growth is slowing at the same time so dramatically, that the stagflation story that's been around for a while, that we were going to go back to the 70s, it looks like we've got good growth, and I think people can handle those higher rates if growth is pretty good, and that seems to be what both the stock markets are reflecting and what the economy is reflecting. What are you looking for in the next couple of months on the data points to see which way we're actually going, and you think that the Fed is going to end up being most focused on?
Yeah, and I think that's going to be one of the most important questions that might be asked to Powell on Wednesday is, are you now getting concerned about growth being too strong and that putting a wrench in your inflation story? I think he'll say it's okay, we still have the supply side, but we have to keep an eye on it. Our base case is that you'll start to see core inflation run at about 0.2%, and this is core PCE, 0.2% month on month, and that's kind of the bogey that they'll need to be able to cut. But July is probably looking a little bit soon. It's a tough hurdle, but they'll still probably be able to cut this year. But it's going to be you're going to need to get that inflation coming down closer to that 0.2%, which is closer to the Fed's target. Our base case is you have seen a lot of seasonality in the data in the first quarter. So we genuinely agree with the Fed that has been talking about the seasonality problems. We were worried about the seasonality in Q1. It goes the other way in Q2 and then throughout the rest of the year.
Interesting. Sarah, this is the big equity market question, isn't it? Are we putting off rate cuts for the right reasons or the wrong reasons? From an equity investor perspective, still the right reasons?
It still looks like the right reasons, yes. And unless that changes, I think that's another reason that with the earnings coming through, people can look at the market and be comfortable with it. And the question really is, if we start to see the wrong reasons, I think that's going to be a much bigger issue.
The stagflationary feel that some people thought we had in the data last week. What did you make of that? Just walking away from GDP last week and seeing some notes mentioning the S word, stagflation.
Definitely not stagflationary.
Hard no.
Hard no. So when you look at the GDP data, okay, fine, it missed on the headline number. You had a one handle on your print. But when you look at the details, it was driven by trade and inventories, which are incredibly volatile. Imports were up pretty strong. That's not a sign of a stagflationary economy. So if you strip out trade, inventories, and government, your domestic demand was growing 3.1%. That's not a stagflationary type environment.
Stephanie Roth of Wolf Research. Stephanie, love it. It's good to see you. Remind me of that number for Friday?
270.
270.
And 0.18 on wages.
Okay, appreciate it. That latter point's the important point, right?
Sure.
Impressive, impressive. Okay, let's get an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Senators are dismissing House Speaker Mike Johnson's call to send the National Guard to college campuses. Johnson visited Columbia University last week. There, he condemned pro-Palestinian protests and said that there would be a, quote, appropriate role for the National Guard if demonstrations were not contained. Both Republican and Democratic senators dismissed the idea. J.D. Vance of Ohio said maybe just call the police, while Tim Kaine of Virginia called it a very, very bad idea. U.S. junk bonds finally eked out gains last week after suffering 3 consecutive weeks of losses. Supply was light and corporate earnings were strong, helping to prop up the market. Yet Mike Scott of Man Group says the market is overlooking unsustainably over-leveraged business models. He spoke with me earlier on Bloomberg Brief.
As rates start to percolate their way through the economy, through the refinancing channel or through cash flows of businesses, this becomes much more of a cyclical issue. Certainly not the case today, but we certainly could very much build a more negative view around the default rate cycle picking up from 2025.
And you can watch The Brief every weekday morning at 5 a.m. German bonds are retaining their bid this morning, despite German inflation accelerating for the first time since December. The euro, for its part, is holding on to gains it had before the data. ECB President Lagarde has already reiterated she won't pre-commit to any rate path beyond the summer, helping to anchor bond yields around current levels. Data for the full Eurozone is due tomorrow. That's your Bloomberg Brief. John.
Danny, thank you. Great work as always. We'll see you tomorrow morning. The ECB, the next meeting, June 6th, I believe, and we're looking for that first interest rate cut. As Danny suggested, after that, kind of no man's land. Up next, Amazon and Apple on deck.
Betting against Apple in China has been the wrong move. And in our opinion, it's 220 million iPhones there. 130 million have not upgraded in 4+ years. That growth opportunity will be on the horizon.
In just a moment, we'll catch up with Bloomberg's Ed Ludlow, live from New York. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
Monday morning, good morning to you all. We are about 45 minutes away from the opening bell in New York City to kick off a brand new trading week with futures positive by 1/3 of 1%, around about 1/4 of 1% higher on the S&P. Under surveillance this morning, Amazon and Apple on deck.
Betting against Apple in China has been the wrong move. And in our opinion, it's 220 million iPhones there. 130 million have not upgraded in 4+ years. That growth opportunity will be on the horizon. I think Thursday, it's really about Apple showing that growth as you go into the June quarter, September, what we're seeing in China, that turnaround's there. And this all sets up for AI coming to Cupertino.
Here's the latest this morning. Amazon earnings due tomorrow, Apple Thursday, following strong numbers from Microsoft and Alphabet. The latest results helping stocks record their best week of gains this year and sending a clear message to investors. AI spending is paying off. Ed Ludlow joins us now for more to look ahead to what's happening in technology ahead of his program with Caroline Hyde a little bit later this morning. Ed, dominating the story this morning, it's not Amazon, it's not Apple. It's right here with Tesla, up in a pre-market by close to 13% following that surprise visit to China from Elon Musk. Ed, what was your reaction to that?
It's just a crucial step in the plan that Musk outlined for full self-driving or this autonomous future. You know, I heard you talking to your guest earlier about there are some CEOs that do China well and some that don't. And Elon Musk has always had a relationship with China, frankly, as a good base starting line. It's become a bit more complicated in recent years, but Premier Li Cheng, who he met with Sunday, was one of the kind of leading officials when Tesla wanted to set up Shanghai in the first place. And his ability to go there and unlock that key step, a tentative or prelim approval, it serves them in the short term because they can unlock software revenues, much higher margin, in what's a competitive market for driver assistance technology, but long term it feeds into what is now the sole thesis for many, which is robotaxi and autonomy.
And who's actually got the IP here? That's what I want to get into. Typically when we talk about a partnership, a US firm or an international firm going into China, pushed into a partnership, often would be asking questions about the Western firm sacrificing IP. Who has the IP here?
For me, actually, this is the key question, and to answer your last question, this is the big takeaway. So it's a partnership with Baidu, according to Bloomberg's reporting, for in-car mapping and navigation, specific to that market. And the reason that's interesting is Tesla has actually used Baidu in China since 2020. You know, the car's ability to read the world around it is localized, right? You have 8 onboard cameras, and the algorithm or the artificial intelligence that powers FSD is trained on that camera data, but in combination with the map that you're navigating against. And so in this instance, Baidu has become an even deeper stakeholder in Tesla's future in that market. And I think you'll see that Baidu's ADRs, at least, are up in pre-market as well.
So they're using Baidu's technology, but where does the data get stored?
Well, this is the other key development overnight, that there are many hurdles that Tesla would have to pass. One of them is getting the regulators' green light on their data practices. You know, I mentioned Musk's success in China and his relationship with the country's government, but actually the data issue is still sensitive. So for example, Teslas cannot be in close proximity to Chinese military facilities because of the cameras around the car and the concern that they're capturing data. The approval that Tesla got overnight is that regulators basically buy the idea that a consumer and I guess another entity that has the power to can switch off the car's ability to gather data if they feel that that's what they want to do. But I guess that was a key concern. If there was ever an idea that, well, when's Tesla going to do this? The Baidu piece is interesting, the relationship is interesting, but this data approval is probably the bigger milestone in this instance.
Does this then leapfrog them on top of everybody else on the EV space in China, and or is there anybody who's working on a similar set of abilities to do this, or is this one of those ways where I've just jumped over the competition and therefore I can reap the benefits of that for some period of time?
Good morning. Excellent question. I mean, in China, just as with the EV market more broadly, the market for advanced driver assistance is also more developed and there's more choice. There are many more players. XPeng and Xiaomi market this very heavily. You know, in North America, you look at General Motors and Ford, which has its own issues with regulators this morning, are offering more limited versions of a driver assistance tool. But it's more saturated, and it goes back to the idea of, well, why is Baidu on the mapping side important? There are actually 20 potential partners in China Tesla could have gone to for mapping. So they're actually reinforcing an existing relationship. But yes, it's competitive, and there's no guarantee that they'll suddenly start selling these $8,000 packages or have incremental subscription revenue in the same way that they've been able to capture it here in the US.
Did they lock up Baidu so that it can only be working with Tesla and not with some of these other players? Or is this one of those things where they said, we're going to take the biggest player in here and we're going to put it together with Tesla and we are going to then become a juggernaut, and too bad for the rest of you because you're not going to be able to catch up?
Good question, Sarah. I'm good. I'm not that good. I don't know about the exclusivity of Baidu and Tesla's relationship. But one thing I would flag is that basically, think of this as in the bigger picture. Tesla knows it has to gather lots of miles to train its more promising neural nets. What I reported last week is there is a very top secret small batch of future generations of the underlying large language model that they hope will power a robotaxi. Tesla has 1.7 million vehicles sold in China. So those miles driven under this arrangement, no matter whether they're exclusive or not, will add great value to the longer-term goal.
Self-driving really spooks regulators stateside, Ed. This is what we got just moments ago from AP, that the US is probing crashes involving Ford's automated driving system. Ed, could you comment on that, how difficult and complex things are for some of the US manufacturers trying to ultimately deal with the same technology and roll it out a whole lot more quickly?
Yeah, I mean, this relates to Ford's Blue Cruise, right, which is, as I kind of outlined earlier, it's a more limited advanced driver assistance tool. You know, Ford and General Motors have been much more careful not to market it as true autonomy, and yet, you know, NHTSA and other regulators still take a very close look. There have been incidents, right? You know, we're talking, think of all the people driving every day here in America. I think in Ford's case, we're talking about 20 or so situations that occurred, or accidents. That's and then, you know, as you know full well, John, Ford's got some other problems in its structure and its transition to EV that it's dealing with at the same time.
Yeah, that's for sure. Perhaps handling them better than others, though. Ed, let's look ahead to next week together. The next week, we've got Amazon tomorrow, Apple on Thursday. For you and Caroline throughout this week, what's the big focus going to be for you and the team?
Yeah, the bar's really high for Amazon now, or there's a lot of pressure on Amazon. You know, what we learned from Google and Microsoft, the number 2 and 3 in the market, is not just that there is actually some growth being juiced out from AI, but actually spending broadly on cloud has been quite good. So if you take the Microsoft example, 31% top-line growth in Azure, they gave us a tangible 7% contribution within that 31 was specifically from AI. But that also means that you have 24% growth coming just from corporate spending on cloud. And whether Amazon, which is the clear market leader, AWS in cloud, gives us the same is important, you know, because then you'll learn whether or not they're holding market share or ceding market share to those names. But that's kind of the big story for them. AI now shows up in the financials. Good. We've been talking about it for quite a long time until that was the case. And then on Apple, I think, you know, we know it's a China iPhone story.
Big time. Ed, thank you, buddy. Looking forward to catching up with you through the week. Ed Ludlow there of Bloomberg Technology. Look out for Ed alongside Caroline at 11 a.m. Eastern Time on Bloomberg TV. Equities right now positive by 1/3 of 1%. Let's get that graphic up again. The week ahead in US markets, in fact global markets, we're looking for two big tech names, Amazon and Apple, the Federal Reserve sandwiched in between, and the cherry on top is payrolls on Friday. Sarah Hunt of Alpine Saxon Woods with us through the last 50 minutes or so. Sarah, just a final word on that. If you could take your pick right now, the data, the Fed decision, or the earnings, what would you take?
The earnings.
Why so important?
Because I think that the market has already started to game out the Fed decision. They've already started taking rates off the table. And I think that somebody made the point earlier this morning that we're already possibly even thinking about no cuts at all, at least quietly, if not in the WIRP situation. And I think that the data has been mixed enough that anybody could pick and choose the right data that could, whatever thesis they had, they could have it. Earnings are earnings, and cash is cash. And so that is what people are looking at to say, okay, you've had these big valuation moves, you've had these big multiple moves. Am I keeping up with that on the earnings and on that cash generation? And I think that that is critical. And if companies can continue to do that, then I think there's less vulnerability. It's when that starts to slip that you see more vulnerability.
Sarah, I've loved this. It's been great to catch up. We'll do it again soon. Sarah Hunt there of Alpine Saxon Woods. Big week ahead, going into the opening bell about 35 minutes away. Equity futures are positive here by, let's call it 1/3 of 1% to be generous. After a big week of gains last week, we're adding a little bit of weight to it in the market this morning. In the bond market, yields are steady compared to what we have seen through the month of April. On a 10-year, we're down by about 3 basis points, 463. Tomorrow, Brammer will be back. This is the lineup for you. Former Fed economist Claudia Sahm, BlackRock's Amanda Lynham, Ron Temple of Lazard, and Citi's Rob Sockin alongside Anne-Marie's voice, making a comeback. Live from New York City. Have a fantastic week ahead. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City for our viewers worldwide, a very good morning. I'm Manus Cranny. We're counting you down to the start of trading, and it's a game-changer moment for Tesla. Did you buy the dip? Have you got moments of deep regret? We can prevaricate about that. Countdown to the open kicks in right now. We're bid. Coming up in the show, as we've shown you, those futures are edging higher. It was the best week since November. Earnings season ramps up and on. Amazon and Apple are on deck. And investors look ahead to the Fed for another payrolls report. We begin with the big issue, Elon Musk's drive to China.
It's a watershed moment. I mean, this is 3 years in the making that Tesla has been trying to get into China from an FSD perspective. And this unlocks a golden opportunity, not just for Tesla in China, but I think globally. And I think it's going to come as a surprise in a good way to investors. Long time in the making. It's a trophy case moment for Musk getting back on that plane, come back from Beijing.
Joining me now is Ed Ludlow of Bloomberg Technology. Ed, the question is, does FSD, in other words, near automated driving in China, if it works there and it gets past there, how quickly can that be the playbook for America and beyond?
It's the multi-billion, tens of billion-dollar question. I mean, I think that's the thesis. What we reported about 10 days ago is that right now there are a small group of robo-taxi or full autonomy-specific foundation models that Tesla hopes can underpin a broader rollout of genuine autonomy. But in order for that to happen, they have to build out a database of millions and millions of miles driven under the as good as it gets product. Tesla has sold 1.7 million vehicles in China, and so they want to bring the software there for that big picture reason. The stock's up almost 14% with 30 minutes to the open. A big near-term thing as well, is that suddenly they can unlock higher margin software revenue in that market, which is for them a sizable market. So there's the short and the long term. How quickly it will happen, we just don't know, frankly.
Well, he's certainly winning friends and influencing people in China in terms of the relationship with Baidu. The theater was pretty impressive at rolling out the red carpet for Elon, or was it vice versa? Thank you very much, Ed Ludlow. Tesla is bid this morning. It is strong. Let's stay with the tech theme, because Apple are going to face more antitrust headwinds in Europe. Now, this is around the iPad. It's been added to a list of products that fall under the EU's Digital Markets Act. What does it mean? It means that Apple now has 6 months to make changes to comply with a new set of rules. Anurag Rana joins me now from Bloomberg Intelligence. I mean, this is just another headwind thrown in the side for Apple. What is the headwind of regulation? What piece of regulation are they buffering up again with the iPad?
Yeah, so the DMA wants to make sure that if you want to download apps, you don't have to go through the App Store. You can go outside the ecosystem. Now, remember that Apple's already said yes to this for the iOS, which is the bigger revenue base, which is the iPhone. So frankly speaking, them going through this for the iPad shouldn't be a big deal, only because from a relative basis, iPad has a much smaller revenue base compared to the phone. So I don't think that's going to be that big of a deal, only because they've already agreed to do this for the iPhone.
What's the bigger item that we're going to keep an eye on? Obviously, we were shaken last week by the dissipation of iPhone sales in China. What can turn the iPhone sales story around beyond China, if at all?
Yeah, that's not going to happen this year or even next year, only because China is a very big part of the story. Now, very soon, perhaps in a quarter or two, you're going to get into a situation where you have easier comparisons compared to last year. I think that's when we need to see that whether after this 1 year of, you could say, weak sales, do we get into a point that China still starts to pick up, or it's going to be, a secular trend or the downtrend. So I think when Apple reports, we really want to see what management has to say about China and what their strategy is to revive sales there.
Okay, Anurag, let's see what the profit numbers are and the real sales. Bloomberg Intelligence giving us the outlook on Apple. Let's dig a little bit deeper into markets. Lisa Shallett is Chief Investment Officer over at Morgan Stanley Wealth Management. Lisa, I'm listening to the Apple story, I'm listening to the Tesla story, and there's a wonderful word. It's called Damascene. We've had a couple of really important Damascene-like moments on AI and on technology within Tesla. How much does that challenge the whole narrative? We're in some kind of evolutionary Damascene moment of change in technology. Does that change how you look and have to look at this space?
Look, I don't think so. I mean, we've been advocating an idiosyncratic approach to stock picking. We've talked about the fact, beginning in the fourth quarter of last year, that we didn't really feel that the Magnificent Seven were all that magnificent, to a stock. And that they would all win universally the same way based on the same trends. And so you're starting to see that group break apart where, some of the strong are getting stronger with regard very specifically to the generative AI themes, whereas some of the other themes, whether they're, with regard to devices or whether they're with regard to decarbonization and EVs, are facing other challenges. And so I think that the market has begun to differentiate. I think that that's a broader trend that we're seeing even in sectors outside of technology. I think it's healthy for the markets. And overall, I think it's a great stock picking environment.
Does part of that stock picking narrative revolve around, let's say, the infrastructure, the very simple, strange but boring stuff? A data center, big warehouse on cheap piece of land, delivers high ROE. Might not sound very sexy, but it is part of the AI narrative. And to that end, $32 billion would be spent by Microsoft, Meta, and Google on boring but necessary data centers, the plumbing.
100%. I mean, I don't think this is boring at all. In fact, one of the single most exciting ideas that we have for investors has to do with this broader infrastructure theme. Because when we talk about the building of data centers, when we talk about the building of pipes, we're not simply talking about the cloud or servers or chips. What we're talking about is the power and the electric grids and the utilities and electrification and the cooling systems and the water that's required. So this is a huge multi-year theme. The world probably doesn't have enough sufficient power to power all of these data centers that will be dedicated to generative AI. And we encourage our clients to get investment exposure broadly to what we're calling, growth infrastructure, which this is a part, both in the public markets and through, private equity investment.
I look at the laggards in the past 4 quarters in this story, and it's firmly Apple and Tesla, which is about China. It's not all about China risk, but many of their woes have been in part because of their more significant exposure to China. If I want to protect, hedge, as it were, differentiate my exposure to Mag 7, should I be less China-centric and more US-centric, aka Meta?
I don't know that I would draw the lines here by geography. Certainly, the weakness of the Chinese economy has been a downside surprise for the world over the last 12 to 18 months. I think that's been a truism for industrial companies, materials and mining companies, some of the commodity companies. But we're starting to see those trends recover. Rather, I think what we're seeing in the differentiation between and among the Mag 7 stocks, again, is about sectors and segments. Where do you really have strength? Where are you really a generative AI player, and where are you not, and where are you challenged by other things, whether it's the actual manufacturing cost of your product, as is the case, I think, with EVs. What is the situation with your competitive placement, which I think is one of the issues that Apple is facing in devices. These are all real issues that go above and beyond pure geography.
Okay, Lisa, stay with us. We've got a little bit more work to do and broader topics to discover. Joining me now to look under the hood ahead of the opening bell, it is Jess Menton with The Movers. Jess, what have we got?
Well, good morning, Manus. Well, we do have another busy week for earnings. Obviously, last week was the busiest week when it came to earnings, with more than 40% of companies in the S&P 500 by market cap reporting. But this week still has more. So you still have about 30% of the S&P 500 reporting. And then headlining today, though, SoFi Technologies, if you look at that stock, down about 4% in pre-market trading, though this does come after SoFi did raise its net income guidance. And of course, that does come because of bets on fewer rate cuts. But to put this into perspective, this stock is actually down more than 20% year to date, though the company's CEO, Anthony Dodo, did say the firm's results do speak for themselves and that the balance sheet couldn't be stronger. But of course, we did have Ed Ludlow on earlier, and he was pointing out about Tesla stock. So if you look at this stock once again ahead of the opening bell, up about 14%, does come after passing a key hurdle to roll out those full self-driving vehicles in China. And of course, this stock earlier this month did briefly fall below that $500 billion threshold for its market cap, but you did see that company, of course, report its earnings last week, did miss analyst expectations, both on revenue and EPS, but of course that stock managed to rally back a little over 10% because of what many believe to be a positive conference call when it comes to CEO Elon Musk talking about being all in on those robo-taxis. But of course, we still have more earnings coming up this week too. So Apple is coming up after the closing bell on Thursday. So this stock is down over 10% from its high back in December. But of course, it was relative to the S&P 500 in the first quarter. It was actually its fourth worst performance since the height of the dot-com bubble bust. But of course, anytime I've been speaking with portfolio managers this year, anyone who has been maybe having to trim some of their exposure to NVIDIA, they've kind of trimmed that and then have been asking if they could add that exposure toward Apple. So it's going to be interesting to see what the next phase is for this company. And then, of course, on Tuesday after the closing bell, we do have Amazon reporting. If you look at that stock this morning, up more than 1%. So those shares finally reaching an all-time high once again. The last time it had actually reached that high was in July of 2021. So another company to keep a close eye on, Manis.
Okay, Jess, thank you very much. We'll see you through the morning. Coming up in the show, gearing up for, guess what? A Fed decision.
For the U.S., the path towards cutting interest rates, in our view, in the view of the IMF, still remains open. We still think that we would enter 2025, even with the start of interest rate cuts. It doesn't mean interest rates would fall down to where they were before the pandemic.
There's no going back, is there? That conversation next on Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
For the U.S., the path towards cutting interest rates, in our view, in the view of the IMF, still remains open. We still think that we would enter 2025, even with the start of interest rate cuts. It doesn't mean interest rates would fall down to where they were before the pandemic. So strong fiscal position, good management in all countries is a necessity.
The Fed announces its rate decision on Wednesday. Investors are looking for any clues as to how long the central bank will be willing to wait before the cutting of interest rates. Mike McKee is with us now. Goolsbee flew a kite on Friday, didn't he, Mike, in terms of recalibration?
Well, we're looking at data is basically it, and that's the thing. If the data don't improved, the Fed is not going to be cutting rates. And we got a lot of data this week. Interestingly enough, we're not going to be having the data that they really want to see until after the meeting. But tomorrow we get the employment cost index. That'll matter. They want to see what wages are doing, if they're being pushed higher, consumer confidence. Wednesday, ADP and JOLTS. They've been watching JOLTS and ISM manufacturing. What are prices paid doing? What's employment doing there? Of course, we do get Fed and the Powell news conference on Wednesday, and that's going to be really important. More on that in just a second. But Friday is the big day with the April jobs numbers. We also get ISM services, but the jobs numbers will be out after the Fed makes its decision, so not likely to have a whole lot going on. So as I mentioned, Jay Powell is the man of the week. We're not going to get a new forecast. We're not going to get a new dot plot. We will probably get something like he said at his last appearance on April 16th, that given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. In other words, no rate cuts anytime soon. That'll be the message the Fed is trying to send. Where are we going into this? Well, as you can see, we are just barely pricing in a November move, but right now the big money is on December. We'll see how any of that changes once we hear what Mr. Powell has to say.
That is anemic at the very best. Mike, thank you very much. Mike McKee, setting the agenda for the week. My guests this morning are Mike Kontopoulos of Richard Bernstein Advisors, alongside him Lisa Shallett of Morgan Stanley Wealth. And Lisa, you write this: we've gone from an 80% chance of a disinflationary soft landing to a probability distribution with much fatter tails. Specifically, hotter reflationary growth, raising the risks of an eventual economic hard landing in the next 12 to 18 months. Lisa, good morning. We wrapped up the technology. So how fat are these tails, and how real is this risk of a hard landing? Because that's far from the madding crowd.
Yeah, so I think we, had gone to almost a zero probability being discounted into markets as recently as the first quarter. And now we think that there's now a rising and as much as 25 to 30% chance that in the next 12 to 18 months we could get a hard landing and a recession that is literally feels very boom bust. And the reason we say that really has to do with consumer behavior. It's the consumer and the labor market that has continued to hold up here. The consumer is now spending well in excess of the pace at which their wages and personal income is growing. The savings rates are coming down. We know that in the lower income quartiles, that those consumers are, now out of excess savings. We know that credit card balances have started to soar. We know that credit card delinquencies and auto loan delinquencies have started to increase in that cohort. So while there's not an aggregate problem yet, we do believe that if there's any kind of, slowing in the labor market, if corporates do get some of these productivity improvements that folks are hoping for and begin to lay off employees, that there's a portion of the consumer side of our economy that's right on that razor's edge and could fall into a recessionary state pretty quickly in the next 12 to 18 months.
So, Mike, there we go. A non-considerable risk, 25 to 30% of a boom bust. We're on a razor's edge. Do you think that is reflected? And I'm asking a rhetorical question. Spreads are not reflecting that razor-thin narrative, are they? They're chugging along. They're holding on for grim death, really, aren't they, on the spreads? And I've had everybody tell me, clip the coupons, clip the coupons.
Yeah, I think Lisa's time horizon is important to that question. If 12 to 18 months you have a hard landing, then there's no risks at the moment, especially if the economy is heating up, which is what we've actually been talking about for the last 9 or so months. At RBA, we've thought the idea that the Fed was going to cut 6 times or in March was ridiculous. We thought the idea that the Fed was going to cut at all this year maybe even ridiculous. And instead, the market probably needs to price in a hike. When we said that back in Jan and March, we got pretty ridiculed, but it seems to be coming our way in that sense. And listen, if that's true, if the economy is so hot, that it's going to necessitate an environment of higher for longer interest rates. Well, at the end of the day, that hot economy, the strong profits associated with that do actually warrant to some degree tight spreads. Now, that doesn't mean that there's good relative value there and there may be better options elsewhere, which we believe there are. But the idea that the spread environment is not justified given the growth environment, I think, is wrong. It's just that the valuation isn't attractive, and so we think you should go find opportunities elsewhere.
So with that in mind, you're signing not just your tail risk is a rate hike. It's not your base case, but this market has got to price in higher for longer, probably no cut at all. That is a real material risk. Do you think at 4.65 that's reflecting that? Do you think that above 5% in twos, that is reflecting a non-material risk of no cut 2024?
Well, I was listening to Ira Jersey's podcast on the 25th this morning, and the options market's pricing in, a 30% chance of no cut and the potential for a hike. And so I think the market's catching up to that reality, quite frankly, relative to a month or two ago. Do rates have higher to go across the curve? I mean, you could easily make a case for the answer is yes. But I think we're probably getting closer to the upper range here as you get to 10s towards, 5%.
And I think as Bank of America's Michael Hartnett said, Danny and I were talking about this morning on Bloomberg Brief, which was sort of almost anything but duration at the moment. So you're all right, Michael. You'll write a few more tickets between now and the end of the year. You can all rest easy. Lisa, I believe in the Mag 7 forever. Lisa Shallett at Morgan Stanley Wealth Management. Michael Kontopoulos of Richard Bernstein Advisors. My guest this morning, setting the agenda for your week ahead. And it's a heck of a week, isn't it? From airlines to yoga pants. It's a broad church here. We break down the stocks moving the market this morning with your morning calls on Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Finally, Jefferies downgrades Southwest Airlines to underperform. Expect limited upside given the recent Boeing delays. Coming up on the show, ING's Parag Garvey joins me to discuss the upcoming Fed decision. The 10-year yield falls from its peak, but is it as it should be if we divine what history tells us about peak Fed moments with peak Fed rates? This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we've provided ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Euphoria and relief rally this Monday morning, same as the Kentucky Derby coming up. You want a hat, there's the bit of the style icon. If you're looking for style icons in stocks, it is unreservedly going to Elon Musk. When it comes to style and substance, he's delivered both. Swoops into China, locks up a deal, doing a deal with Baidu, at the same time promising the world and the market autonomous driving is very real. There's the opening bell. We're bid up on SPOOs. You're going to have Jay Powell speaking this week. You're also going to get information from the quarterly Treasury funding requirements. That could be pivotally important. Now, have a look at dollar yen. You're looking at a pullback, but there has been a demonstrable strengthening in the yen. It rallied by as much as 2.3%. Why? Huge speculation. We broke through 160, the lowest since 1990. That invoked the narrative that there was intervention. Kanda, the top FX strategist in Japan, or monetary authority, I should say, would not confirm or deny whether there was intervention. He's going to keep us on our toes until the end of May. So we have this reversal in dollar-yen. Do you want to stand in front of that truck? Not really. Yields are down by 2 basis points. We've got the Fed, the jobs report, and the quarterly refunding. Oil is down by 0.5%. One stock to watch. I told you it is Tesla. Elon Musk's quick trip to China. It paid off, receiving tentative clearance for its driver assistance software in China. It is, some would say, the make or break moment in shifting the gears on a stock's demise. Ed.
Good pun, but technically there are no gears in battery electric motors. I'll let that one go. The stock's up more than 10%, but there's no size or scope because it kind of matches the gains we saw April 24th, the day after earnings. This is tentative or prelim approval from China, subject to certain stipulations and conditions, according to a Bloomberg source. There are two key subsets within that. The first is a mapping and navigation agreement with China's Baidu for the localized mapping needs in that country. Tesla's had a relationship with Baidu since 2020, and so it's an extension of that existing technology agreement. And then the other half is securing some approval or green light on the data and privacy side. Tesla and Elon Musk have a long-standing good relationship with China on the whole, but more recent friction has centered around the data gathered by cameras on the exterior of the vehicles, including some anxiety by Chinese officials over the proximity of Tesla cars to government or military facilities. So they've kind of passed the data privacy test. This was a last-minute, unannounced, important trip by Elon Musk to China a week after he snubbed India. It is a key market where Tesla has sold more than 1.7 million vehicles. In the short term, allowing them to recognize higher margin software revenues when they will be permitted specifically to start selling a version of FSD, we do not know. But in the bigger picture, it's also critical to their training of those future iterations of full self-driving, which is not as it stands for autonomy. In America, for example, Manus, as you know, you have to have your hands on the wheel and your eyes on the road. There has to be driver supervision. Yeah. But the big picture is they're working towards true autonomy, and as we now know, a robotaxi. Stock up 10.7%.
Okay, Ed, thank you very much. Ed Ludlow there on the Tesla story. Let's pivot to entertainment. Paramount's board is considering removing its CEO while it evaluates the possible sale to Skydance Media. Jess Menton has the details. Jess.
Well, Manus, if you look at this stock, right at the opening bell here, that stock's up about 5%. To put in perspective, though, that stock's down about 20% year-to-date through, actually looking through Friday's close here. So when you look at this and what's really supporting the stock here, if you're looking at Bloomberg News, it is reporting that the Paramount board is actually weighing removing its CEO amid these different sales stocks. So we keep getting all this different news coming out about this company. So Paramount Global shares actually really jumping pre-market. So you are seeing basically the Redstone family here, as well as Skydance Media CEO David Ellison. They've actually both offered concessions to make it possible for change in control at the media company in a bid basically to appeal their other investors here. And then also, if you look over CNBC's David Faber, they're actually reporting over there that Skydance has made a final offer for Paramount. So if you're looking at this, Paramount Global's board is preparing to remove CEO Bob Bakish as early as this morning. So this is a stock to keep focus on here, especially when you're thinking about the dynamic here, and especially the Redstone family, who do own a majority of the voting shares with this, Manus.
Okay, Jess, thank you very much. Let's stick with the entertainment theme. AMC reporting preliminary revenue for the first quarter that beat average analyst estimates. Isabel Lee is with me on the news flow. What have we got?
Hey, Manus, shares are falling around 8%. This is interesting because the news came out Friday after the market closed, and shares rose as much as 7% post-market. So investors are probably still digesting the news. We have AMC expecting first quarter revenue to be flat compared to a year ago, and that's despite a weaker slate of film releases denting box office returns. So again, this is based on preliminary results, and the company reported first quarter revenue to be at around $951.4 million. That's a 10.5% beat compared to average and analyst estimates, but again, it's flat compared to a year ago. So we have the company saying that the Hollywood writers and actors strike really affected their box office returns, and while they expect this to continue in the next quarter, they do expect the situation to improve overall. We have cash balance falling to $624 million on a $164 million net loss. So the full quarter, first full first quarter results will be on May 8. Again, this is preliminary, and shares are down 50% year to date. And today, they're still down around 6%, Manus.
Isabel, thank you very much. Certainly under pressure. The SoFi Technologies is lifting its full year earnings guidance. It's the online bank. It's anticipating higher for longer rates. It's also leaning more heavily into its financial services and technology platform rather than the traditional lines of business. Katie Greifeld has the details. So what's the nuance here? The stock market certainly not receiving it very well at the moment.
Yeah, you can see shares currently down almost 9% as actual cash trading gets underway. So let's get into the details, because you're right, SoFi, it did boost its adjusted EBITDA guidance for the full year. Some of the numbers there, adjusted EBITDA, it's seen between 590 million to 600 million. It had seen 580 million to 590 million. So again, a raise there. But then you take a look at the near term, and there's some things to get worried about. For the second quarter, they're forecasting adjusted net revenue of 555 million to $565 million. The estimate had been for $590 million. So a bit of a disappointment there. It's the same thing if you take a look at EBITDA, that range that they're anticipating, 115 million to 125 million, coming in below the analyst estimates. So long-term, full year, good news. Near-term, bad news. The reaction that you're seeing in the markets right now, making a bad year worse for SoFi. Shares currently down over 20% in 2024.
Okay, Katie, thank you very much. Katie Greifeld tracking the stock moves. So 10-year yields, they're falling from the peak. Porrick Garvey is the head of debt and rate strategy over at ING saying this. What is clear is market rates have not fallen by anything near what we would have been typically expected from a Fed peak moment. Porrick joins me now. So, Porrick, good to see you. The debate is the market has not adjusted sufficiently for what you and I would refer to as a Fed peak, which was last year. So it's not adjusted to that, but nor is it really ready for a hike. So where do we fall in terms of market pricing relative to the peak? Because this is a very, very pivotal week for messaging from the Fed.
It is, Manus. It's a huge week. Got lots of stuff going on this week. I think the Fed is interesting. Chair Powell had a clear pivot last December and basically told the marketplace that there would be cuts this year. And I'm quite impressed, actually, with the resilience of that rate cut discount. Now, we ourselves think the Fed cuts in September this year. But one of the things that I find remarkable, and you intimated that just a moment ago, is that when the Fed has peaked in the past, market rates have fallen. The 10-year rate typically falls by 50, 75 basis points. That has not happened this time. If I was a Martian alien that came down to Earth and looked at the 10-year Treasury yield, and I looked at what the 10-year Treasury yield has done over the past few decades when the Fed peaks, I would conclude the Fed hasn't peaked, just based off the price action.
Well, if the price action in theory, and you're in the market, so you correct me where I'm wrong, the theory is that we've not peaked because we're very unsure that we've seen the peak of inflation. If anything, the risk is disinflation slows, and you could have higher, sticky, resurgent inflation, dare I say it, stagflation.
So we're running the risk that the Fed keeps rates too high for too long. And that's always the issue. I mean, if you look historically, again, what you find is that central banks don't want to create a recession, but they typically are forced to do so because the economy just has a momentum that has to be nipped in the bud by keeping rates too high for too long. And we are facing that risk going forward. I mean, if you look at the headline data, there's a lot of bullishness there, a lot of optimism with respect to the economy here and now. But there are issues in the background, absolutely. I mean, we see them in the labour market, we see them in credit card spending, we see it in delinquencies, not critical at this point, but liable to become an issue going forward, which is why the Fed and moreover the market has that baseline discount that the next move is down.
So if the next move is down, if some of these fragilities become a little bit more tense, that would give them the cover to cut rates. I'm reading notes that say anything but duration. So if your thesis is cut in September, is it one and done? Is it multiple cuts? And is it everything? You know, are you all in on duration then between now and September in preparedness for the trigger being pulled?
So, Manus, between now and the fall, September, yes. On the theory that, again, going back to history, when the Fed peaks, rates fall. They haven't fallen this time, but when the Fed cuts rates, we would expect to see yields fall. The issue is between now and then, because at the moment, 10s are up at 460 and have eyes on 5%. So you want to play this tactically. I'd still be short treasuries here, looking for 10s to get to 5%. I see a lot of pressures externally, in fact, pushing that direction, including the Japanese yen so-called intervention. So going forward, it's higher rates for now, but between now and September, if the Fed does cut in September, I would expect treasury yields to be falling at that time, yes.
Let's have your opinion on intervention. Kanda is keeping us all in suspense. You know, you see this kind of magnitude of move, we're all drawn to speculate that it is intervention. But let's talk about the ramifications of intervention on a slightly more global perspective. Give me yours.
So my view is that we've got Japanese rates sitting significantly below US rates. So to square that circle, what has to happen is that the Japanese yen should be appreciating, not depreciating. So we don't have an equilibrium situation. And you see that in FX forwards. FX forwards show a stronger yen versus the dollar. If the yen persists on tracking a weaker trend versus the dollar, something has to give. FX intervention traditionally hasn't been a structural solution. The only way to solve this issue is for Japanese rates to rise. Either the markets will do it or the BOJ will be forced to do it. So I see it as another impulse out there globally towards upward pressure on market rates.
And that, do you think that's going to be more rate hikes from BOJ rather than, respectfully, good money after bad, which goes after trying to put a floor in yen when you have a strong dollar, when you have an interest rate differential? The only thing that changes the narrative significantly here, unilaterally, is higher rates. And the word is unilateral.
Right, and it's pretty clear that the BOJ doesn't want to hike rates. So I would see this as being a market pressure story. I think market rates just have to rise from the back end, and that'll pull the BOJ along with it ultimately. So you know, it's one of those factors out there that is again pushing up global rates.
Okay, well, Pádraig, we can smell the blood in the water for 5% on 10 years in treasuries before we begin to pile in and go long. Pádraig, thank you very much. Pádraig Gavi there at ING. Coming up, US Secretary of State Antony Blinken steps up his efforts to secure a truce in Gaza.
Right now, as you said, Hamas has before it a proposal that is extraordinarily generous on the part of Israel. And in this moment, the only thing standing between the people of Gaza and a ceasefire is Hamas.
We look at the next steps to achieve peace in the Middle East. That's here on Bloomberg.
Season 2 of The Circuit. We're walking with the titans of banking. Hello!
You guys love...
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
The Israelis don't. They want to be able to keep pressure on Hamas, especially since it won't have given up all of the hostages. And, you know, so it's always been very, very difficult. It's been a long time since there was a successful deal. That was months ago now, when 105 hostages were released. But the pressure is really rising on both sides. You know, first of all, on the Hamas side, the Israelis made it clear that a move on Rafah, where Hamas leader Sinwar and about the remaining, 4 battalions of intact Hamas fighting force are holed up together with about 1 million refugees. And that is imminent, and the Israelis have made it clear that, if they don't get a deal on a ceasefire now, they will go in. On the other hand, the Israelis are also under pressure. Prime Minister Benjamin Netanyahu has faced rising numbers of protests recently, led by families of the hostages and others who support them and really want to see him resign. And so he is under pressure also.
I mean, obviously, 1 million Palestinians with those other holdouts from Hamas in one location in Rafah. This is reaching some kind of an additional break point for everybody on the global stage.
Absolutely. I mean, it's a big choice for the Israelis to make at this point, and it's a big choice for Hamas. You know, for Hamas, clearly, it's about survival and how they get out of there if they want to, if they still think that they can win by drawing in other forces into a war. And on the other hand, for the Israelis, they have to make a choice because if they do go into Rafah, the pressure is going to increase internationally, and they will be increasingly alone, which is a very tough place for Israel to be.
Yes, that's probably not where Netanyahu wants to be left. Mark, thank you so much. Mark Champion with the latest developments from Antony Blinken. He travels, we understand, further around the Middle East to Israel next. And beginning next Monday, you can join our coverage, Jemana Bersecci, on Horizons Middle East and Africa, live every day at 8 a.m. in Dubai, 5 a.m. in London, midnight in New York. Some sector price action. Let's get back to Jess.
Taking a look at the S&P 500, trading back above that 5,100 level here. And if you look on a sector basis, 9 of the 11 industry groups are higher, of course, led by consumer discretionary and real estate. If you look at the opposite end, though, communication services down more than 1%. And this is because what we were talking about earlier, man, is looking at the S&P 500's media and entertainment group, that down close to about 2% today. That does have to do when you look over at Paramount shares, PARA is the ticker symbol on this. It's actually, if you look at this stock, though, that one is actually up about 6%. But when you look on the opposite end of that, when you're looking at what's happening with shares of Alphabet as well as Meta, those two stocks are down about 2% a piece here. And so that's what's actually weighing on that particular corner there. But again, the S&P 500 is coming off of its best week of the year last week. But again, if you look on a monthly basis, the S&P 500 is down close to about 3% this month. So that would put it on pace to snap a 5-month winning streak, which actually is pretty rare to see that 5-month span between November and March in those gains. But of course, the S&P 500 rallying roughly about 20% off that October low. But still, of course, a lot of earnings coming up this week, as we talked about earlier, Manus, when you're looking at Apple coming on Thursday. And then we have Amazon after the bell tomorrow. And then, of course, we're going to have Coca-Cola and McDonald's later this week, too.
Yeah, it's going to be fit or kill on some of these bigger tech names as well, and on the broader market. Jess, thank you very much, Jess Menton. Coming up in the show, market moving events to set your clock by on the trading diary. And guess what? The Fed and jobs will be front and center.
This is Bloomberg.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Spoiler alert, Coinbase That's what's dragging us back a little bit. You've got a mighty showing by Tesla, but it is Coinbase, which is down by over 5.6% at the moment. Yeah, that's the price check on that. Russell is up by 0.4%. Yields are ticking off ever so slightly. We'll find out about the quarterly refunding and, of course, what Jay Powell has got to say to the market. Your trading diary looks a little bit like this. Amazon reports after the bell tomorrow. And we get the Conference Board consumer confidence numbers. Wednesday, it's pivotal. We got Fed rate decision and Jay Powell speaking to the market. Apple gives you their numbers after the bell on Thursday. And Friday, we begin to comprehend the jobs market in the United States of America. What are the wages looking like? And we'll bring that to you blow by blow. We've got a Fed special on Wednesday. Countdown to the open. That is your Monday kicker for you. The rest of the team will take you through the trading day right here on Bloomberg. Good morning from New York.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well, so you can head over to youtube.com and search Bloomberg Podcast. Alex Steele back where she belongs in her seat. Paul Sweeney here. We're going to drive you for the next 2 hours. Bloomberg Intelligence. We focus on companies and their stocks, their bonds, and how they're fitting in with these markets and trading. We lean heavily on the over 400 professionals at Bloomberg Intelligence, the in-house investment research department of Bloomberg. We'll have a lot of that over the next couple of hours. We're going to take a look at Tesla. That stock is higher. Craig Trudell is going to join us. He covers it from Bloomberg News, and we're going to talk about that because that stock is up 12%. Elon goes to China, and boom, big positive moves there for our good friends at Tesla. But right now, let's go to John Tucker, kick this thing off. Hey, Bloomberg Business Flash, John.
All right, Paul and Alice, we're being brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interests at ibkr.com/RIA. Well, after the best week for equities this year, the new trading week, seeing major averages pushing higher right now. 9 of the 11 major industry groups in the S&P 500 are up. Consumer discretionary is in the lead, and that is home to Tesla. Those shares, as Paul just mentioned, they are up 10.5% right now after the Chinese government gave tentative approval to their driver assistance system in that country. A Fed week, but could be a sleeper as no change in policy is expected. Lori Calvasina at RBC Capital Markets, she was on the program a little earlier. She says this week's Fed meeting will take a backseat to the earnings reports.
We've got 166 companies in the S&P reporting this week, at least last I checked. So I think, as always, people are going to pay attention to the Fed. Personally, I'm looking for that commentary to kind of catch up with where the market already is. I'm much more interested, frankly, to hear what companies are saying about the current environment.
Paramount Global shares, they were up 4.5%. The Redstone family and Skydance Media CEO, they both offered concessions to make a possible change in control of the company a little more appealing to investors. Overall, S&P 500 up 14 points. That's a rise of 0.3%. We're at 5113 on the index. The Dow Jones Industrial Average up 110 points. That was up 0.3%. Nasdaq 100 right now 27 points higher. That's up 0.2%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Welcome back.
Hi, guys.
We missed you.
It's been so long.
How was your vacation?
It was wonderful.
Good.
It was wonderful. I should point out for a radio audience, Paul has more sun on his face than I do. I'm just saying.
Jersey
so
Shore.
I feel like I did something right.
So you did the hat, under the tent, under the cabana.
Yes, the
Perfect.
whole thing.
The whole
SPF 5,000.
70, but they don't make 5,000 SPF.
All right. It worked.
What did I miss?
Boy, just...
What did she miss?
It's just all a blur.
It was a great earnings week. That's what
It was a good earnings week, right?
Yeah.
But there was one day where stocks didn't do so well, right? That happened, and then they rebounded, and
Here we
stocks
are.
go up, stocks go down, stocks go up.
And here we are, another up day in the marketplace.
Yeah.
With another big earnings week, we got Amazon after the close tomorrow, Apple after the close Thursday, plus a million other companies.
Yeah, and I'm actually excited about Paramount. We can talk about
Yep.
that later on in the show as well. So let's get some more details here. She can help catch me up with everything here. Carmen Reinecke joins us. She's Bloomberg Equities reporter. So Tesla, what's going on there?
Yeah, so Tesla shares are up 11% this morning. That's ticker TSLA. And basically what happened here is that the company received in-principle approval from the Chinese government to deploy the driver assistance system in the country. This is the world's biggest auto market, so a huge deal. It cleared 2 of the most important hurdles to deploy the system in China. So a big move for Tesla. It's back now at levels that we haven't seen since March, and it's obviously, it's been really weighed down this year. So I think investors getting some really positive news, which has been great for shares. Paramount, also one that I'm watching, that's ticker PARA. it's up about 5% right now. It's paired a little bit from its intraday high at 7%. Yeah, basically the Redstone family and David Ellison, Skydance Media CEO, both have offered concessions to investors. Ellison saying he's proposed to buy a block of Paramount shares at a premium to help sort of shore up the finances. And the Redstone family, which owns the majority of the shares, have agreed to let non-voting shareholders have more of a say on the
Yeah, and I don't know what that means. I don't know what that means. The way you do that is you offer the same price for both the voting and the non-voting stock. That's what you demand. If you're Mary Gabelli, that's what I suspect, something along those lines he's going to demand. And there's also reporting over the weekend that Bob Bakish was going to be forced out of the, he's the CEO, and be forced out of the CEO role. And I saw some reporting that the reason is that he was been, I guess, arguing that the public shareholders, the non-super voting shareholders, the non-national amusement shareholders should be treated much more fairly than maybe some of the initial deal structures.
I mean, he cut the dividend, right? I mean,
yeah.
I mean, he convinced them to do it, but nonetheless, like that's not a good thing when you're then upset about the shareholder vote. My take on this, my informed vacation brain take.
Kicking back. Yep.
Hot mess.
Yes, very.
I think that's a fair take, right?
Exactly.
Okay, may not be very scientific.
Yeah, I mean,
but
you don't see with all that's going on with Paramount. Then this story pops out of nowhere that the CEO might be booted out. Like just what they needed. Okay.
But also and we'll talk about this later on in the hour too. But I was reading through a great piece, a more in-depth piece about how many times they said no to merger deals or sell-offs in some different assets. That was impressive.
Believe me, I was involved in a lot of those discussions. Like, yeah, guys, I got to think about it. I mean, Rupert Murdoch now looks like one of the smarter people in the media room because he sold years ago, and while he didn't get full valuation from his perspective then, it's a lot better than he would be doing now.
He sold it. All right, you're also looking at Domino's Pizza reporting earnings. That's snag up nicely today.
It is, yeah. So it's up about 3% right now. This is ticker DPZ. Just a nice earnings, story here, I think. So basically, the company reported U.S. same-store sales that beat expectations, which was a really positive sign for the turnaround. They've also had a CEO leave, come back. They have a new CEO now. That CEO said in a statement that the gain in orders was seen across all income groups. So I think this is also really positive, just showing that, they're making gains with a lot of different consumers.
I still want to see a graph overlay of pot sales with sales at Domino's Pizza.
Very good.
Because I do maintain that chocolate lava cake is like a favorite of stoners. What'd you call it? You call it the Spicoli effect.
Yeah, that's why not? I mean,
that's a little dig deeper into this. We need to speak to an analyst.
All right. Carmen, you're up at Vassar College. You're studying hard, cramming. You need some pizza. Did you ever call or do online?
Definitely. Domino's was popular. I think everyone really liked the tracker. That was really big.
What's the tracker?
Where it tells you like your pizza is
being
made, that it's being, prepared, or that it's being delivered.
They give it a name.
Delivery person.
I thought it was like a cool new pizza place.
Oh my gosh, this is like a decade ago.
See, and that's what I think is kind of driving it here, is they made the electronic ordering so easy.
Well, you're not implying anything about Carmen's behavior at the time.
No, she was late night studying at Vassar. You got to get some
hard.
Very
cramming, and they're smart kids up there.
I like Papa John's.
But you're in Poughkeepsie, so it's not like I don't know what the pizza situation is.
Not really a culinary capital.
Yeah,
fair enough.
Good.
All right, Carmen, thanks a lot. Really appreciate it. Carmen Reinecke joining us, covers Bloomberg Equities for us. All right, let's get back to Tesla for a second, dig a little deeper here. Craig Trudell, Bloomberg Global Autos editor, joins us now. So can you play this out over the last 3 days? So Elon Musk jumps on a plane, he goes to China, then what happens?
Yeah, good morning. It has been a whirlwind couple of days, a few weeks, I would say, actually. So just to go back even slightly further, Musk was supposed to go to India a little more than a week ago and called off that trip, said, he had heavy obligations at Tesla, is how he put it. Tesla proceeds to release really crummy first quarter earnings, but Musk kind of pulls a rabbit out of a hat in announcing this change in strategy to get cheaper vehicles to market faster. How exactly he's going to do that is a little fuzzy, but the gist of it is to use existing manufacturing lines to make these new vehicles that could be ready as soon as late this year or early next year. In the process of making that pivot, he clearly needs to sort of get incremental revenue after a first quarter where sales were really weak. They had the lowest revenue since early 2022 levels. And in China, one clear way that they could do that is by offering the system that they've marketed as full self-driving in the U.S. Importantly, we should note it is not a self-driving system, but that hasn't stopped them from marketing it as such for years now.
All right, so Craig, let's focus on this weekend, which seems to be moving the stock today. Am I to understand that getting the Chinese approval for this driver assistance was up in the air, like there was a risk they wouldn't get it, and then Elon hops on a jet, flies over, and saves the day? Is that what happened?
Yeah, it wasn't necessarily the case that this was, kind of an overnight thing. Actually, the last time that Musk was in China, this was something that we reported at the time was on the agenda. It's been something that Tesla has been after for quite some time. And it's increasingly a way that, car makers are competing in China is how advanced is your driver assistance system, that keeps you from crashing, that keeps you in your lane, that allows you in some cases to take your hands off the wheel. But in all cases, you absolutely are responsible for the car. And, no companies are taking responsibility, legal responsibility if you get into a crash. With the exception of some, very small sort of limited fleets and contained areas. And, there are quirks, as you might imagine, by market for what is required to be able to offer these systems that really need to be safe and also need to have, controls for data collection and the cameras used to navigate the surroundings that these cars are going to need to pilot around. And that's been a hang up for Tesla and other international companies that, they need to, in all cases, work with local Chinese companies for things like mapping and navigation. So one of the key sort of, takeaways from this trip was Tesla agreeing to do that with Baidu in China.
So who owns the stuff?
It is, importantly, it's a matter of ownership and where it's kept. And so, this has come up years ago, actually. Tesla had a bit of a hang-up where their cars were banned from, being in the area of military compounds and other sort of sensitive parts of China out of concerns about, any information that cars were gathering. And, there were concerns about whether any data was going from Tesla's China operations back to the U.S. And so Tesla needed to sort of reassure China that, any data collected in China will stay in China. And so that has been, something that they've had to sort of acquiesce to as of, several years ago. But they needed to still sort of, clear, approval for making sure that their T's were crossed and I's were dotted in that respect. And they needed this deal with Baidu. It does seem to be the case that they need to meet other conditions in order for FSD to be offered in China. It's still not a done deal, but what sort of hoops they still have to jump through are a bit unclear at this point. That's not stopping the market from getting very excited about this.
So how does this change, if at all, kind of the competitive landscape for Tesla in China? I know you guys have been reporting a lot how some of the local EV makers have really become very good and very competitive.
Yeah, I think it absolutely is something that's been missing for Tesla, that assuming all goes well here, it will no longer be a sort of strike against them among consumers who really, want the most cutting edge technology. It remains to be seen how big a deal it will be for Tesla from a revenue standpoint, because we don't know at this point how much Tesla will be looking to charge for it. We don't know, to what extent they may have to share some revenue with some of their partners. It's not clear whether Baidu maybe gets a cut. In the U.S., Tesla and throughout the world, Tesla has made a point to really be, want to be vertically integrated. And that's, fancy talk for in control of its own destiny. They were willing to sort of acquiesce in this case, I think because they really could use this boost in China at a time when their lineup is getting a bit tired and they're losing a lot of market share to companies like BYD.
Well, this also raises the question, too. It doesn't take a lot of news to get Tesla stock moving. Not that a trip to China wasn't a big deal, but like you said, there's so many questions as to the actual revenue driver and what it's going to mean. I mean, you have to wonder, it's not going to take a lot for any kind of shorts, Craig, to cover.
I think that's right, and this is also a name that options traders absolutely love. It's sort of like the meme stock that has lasted as a meme stock as that craze has sort of faded away. And so, anytime, to your point, Musk is able to sort of get some momentum with, the narrative, it tends to lead to big swings. So, early this year, I think he lost control of that narrative, and it's not at all a mystery as to why that is. Looking at last week's earnings, but I think he was really able to sort of change what people were talking about last week. We'll see whether or not this is mostly talk as opposed to going to lead to real sort of meaningful change in Tesla's earnings trajectory, which has not been trending in the right direction.
All right, Craig, thanks so much. We appreciate it. Craig Trudell, Global Autos Editor for Bloomberg News, joining us from London. I follow Bloomberg's own Ed Ludlow on social media, and of course, he just got a new Tesla, and I think he uses that autonomous driving features that it has. So he's been reporting today, for example, our boy Ed, who lives in San Francisco, his full commute, about 25 miles, 3 disengagements, but 90% of the drive was under their FSD and all smooth. His FSD made it all the way to the Golden Gate Bridge, but then had some problems about deciding which lane it wanted to choose, so Ed had to step in there. But by and large, Ed's reporting this on a daily basis. He's putting his life on the line for his primary reporting duties.
He's the best.
It looks like it's working.
I guess the question just becomes, like, how much you want to pay for it.
Right.
Like, I mean, sure, it'd be great, but is the average person, not just the tech reporter in San Francisco who also anchors a tech show, like, will the average person spend $8,000 a year for it or $100 a month?
I don't know. I mean, that kind of goes to the bigger issue of costs here. I mean, it remains to be seen for Tesla investors. Is it tough to make? Can they make a profit at a 30,000
totally.
Price limit? There's a lot of concern that they won't be able to do that. But again, Elon put out some good talk on the earnings call, trying to masking over what was a weak quarter.
True.
And then, of course, going over and having this great successful event here in China over the last 48 hours or so.
And that's really helping the equity market. You got the S&P up by about, 0.4%. I mean, it's something, right?
Yep.
And we're going to talk more about that and what's going to happen with rates, look ahead to the Fed, and jobs data as well with Margit Patel. She's Senior Portfolio Manager at Allspring Global Investments. She will join us next to discuss. It feels like this week could be complicated. You got earnings, you got the Fed, you got eco kind of all vying for attention. We'll break it down. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. Earnings continue to drive the stock story, putting the Fed in the passenger seat. Best performing indices group in the S&P 500 that belongs to consumer discretionary. That's where you're going to find shares of Tesla. Right now, they are up 11.8% in today's trading, also among the most active. And ahead of its earnings this week, Apple among the most active. Those are up 3.8%. Bernstein also upgrading its rating to outperform for market performance of stock. We're also going to hear from Amazon.com this week with their earnings report. Its shares up 0.4%. Right now, the S&P 500 20 points higher, up 0.4%, 5120 on the index. The Dow Jones Industrial Average up 116 points, and the Nasdaq 100 is up 63 points, a rise of 0.4%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. I'm Alex Steele alongside Paul Sweeney. You're listening to Bloomberg Intelligence Radio, where we bring you all our top analysts that cover all the things around the world, about 2,000 companies, 130 industries. We go deep into all of their topics. We also keep you updated on what's happening in the overall market. As John was just saying, you got the S&P up by about 0.4%, but it's a really busy week between eco, jobs data, the Fed, and then earnings as well. So we want to break down what is going to actually move the markets. Margie Patel, Senior Portfolio Manager at Allspring Global Investments, joins us now. So I know you're going to say all of the stuff, but let's just pin you down. So is it going to be Apple and Amazon and all the companies reporting? Is it going to be the Fed, or is it going to be the jobs data?
Oh, I think the jobs will be more important because, frankly, what the Fed has done or not done hasn't really had much of an effect on the market either way. When they talked about 3 cuts this year, the market was a little interested, and when the market is now saying, well, maybe they'll even raise rates, it hasn't really affected the market. The market has been looking at earnings. That's what's important. Inflation has not been a negative issue for companies. So I think it's more the same, looking at data that shows the strength of the economy, like the jobs data.
So are you concerned that this Fed maybe got a little bit reticent here about that Fed pivot we had in December, that maybe they went a little bit too far, and maybe they'll try to compensate here this week and maybe talk a little bit more hawkish than the market's discounting?
Well, you know, that their talk seems to have swung a lot more than their actual actions. And the actions that they made, even raising rates for the last 2 years, didn't really derail the market. The market really has proven to be not so sensitive to short changes in short-term interest rates as we've seen in past cycles. So I think and particularly short rates, I think, again, corporate America is pretty much immune to the Fed's decisions. They're not over-levered. So it really, I hate to say doesn't matter, but it really doesn't matter. And I think inflation at, say, 3.5% is really a benign backdrop for corporate earnings, allowing companies to have the ability to raise prices a little bit and keeping those high margins. I think that's what the market's looking at rather than what the Fed is doing or thinking about.
In that case, what are we going to learn from earnings this week? In that, year to date, you got energy and financials are number 2 and 3 in terms of sectors best performing on the S&P. Communication services number 1, but you could argue that's a Meta and an Alphabet thing. And tech comes in at number 4. Is it going to be cyclical leadership? Will that actually happen? Will the earnings deliver?
Well, I think all those sectors that you said are economically sensitive, and so they have all reflected, frankly, a better economy. Last week's earnings were better than the market expected, and we'll see this week if, again, we have better than expected. I expect that we will. And so I think that that's really what the market's telegraphing. When you have those sectors that are sensitive, even financials, energy, that says to me that the market is not worried about economic growth. It's looking at pricing power or a little bit of inflation.
Right now we're speaking with Margie Patel, Portfolio Manager at Allspring Global. And coming up in just a couple of moments, we're going to listen into a Bloomberg Television interview of Lamborghini CEO Stefan Winkelmann. And Matt Miller is not here to participate in that. I know he's going to miss that. So, Margie, here, what are the sectors we should be looking at here as we think about the second half of this year? Where are you guys most enthused?
Well, again, we think economically sensitive sectors are going to do better for the year. So that would be technology. Certainly it's been a volatile sector, but we still think there are plenty of very competitive companies who are not priced, say, too high that will perform better than the market. We also like industrials because we do think there's a capital expenditure cycle and expansion of manufacturing and investment by companies that were very positive. Some of the materials, in fact, we think will benefit. And energy, which has rather been overlooked. Healthcare has been more a group of companies that's reacted to the downdraft after COVID and the drying up of money to be spent on tools and devices by a lot of the new companies. So we think healthcare is attractive still, but very selective because some companies, say Lilly, for example, has a wonderful product. Some of the tools and devices companies have had disappointing earnings because of this dry up in funding and also because of a dramatic lowering of China sales.
Margie, you didn't mention tech, and so I assume that if you don't own tech right now, it's hard to buy it at these levels, but how big of a part should that be of your portfolio?
Well, really, when you look at technology, there are, first of all, many companies now pay competitive dividends, which they didn't used to do. And if you look at their price-earnings ratio versus some sort of estimate of future growth, and then you look at other sectors, price-earnings ratio, estimates of growth, it always seems to me that tech may be a little bit expensive on a price-earnings ratio, but much higher sustainable prospects of growth. When you look at some sectors that are priced almost as high as tech, say consumer staples, really I just don't see the growth there. I don't see the pricing power there. So in an uncertain world, it just says to me technology is fairly valued and it'll really depend on earnings. And so I think it'll continue to do better.
All right, Margie Patel, thank you so much. We appreciate that. Margie Patel, Senior Portfolio Manager at Allspring Global Investments, joining us via Zoom here. And coming up, we're going to have the CEO of Lamborghini on Bloomberg Television, speaking with Katie Greifeld about the future of this company and to what extent does the EV thing work for these big supermotor companies?
I mean, they're fancy, right?
Yeah, and they're loud. Yeah. That's what people like about them. Like the Matt Millers of the world, they want you to know that they're come screaming down the block in a Lamborghini.
But I wonder if it's going to be more about being hybrid rather than an EV. Because you can still get the rev, but you can still make it a little cleaner, and that's sort of maybe that model, which is applying to the regular cars that you and I would buy, would also be the model for the fancy cars. I've never driven in a Lamborghini.
I have.
I feel like I missed
passenger, but yeah, I have not gotten behind the wheel. But we know our friends like Matt Miller, Barry Ritholtz, they're into
And John Tucker owns a couple.
Probably,
so
exactly. All right, so coming up here, we're going to Stefan Winkelmann, Chief Executive Officer, Automobili Lamborghini, with our own Katie Greifeld, talking about the future of Lamborghini, the future of EVs in the world of these supercars. Let's listen in right now.
All right, we now welcome in our TV and our radio audiences for this conversation about Lamborghini, set to debut its first electrified SUV, the hybrid Lamborghini Urus SE. Joining us now, I am thrilled to say we have Stefan Winkelmann. He is the Lamborghini CEO. So this is your second plug-in at, of course, Lamborghini. And I thought it was interesting because it comes at a time when we've really seen consumer demand for EVs really cool off. When it comes to hybrids, though, does the demand picture look the same, or is there more strength there?
Now, the strength is very good on our side. I can speak for Lamborghini. The plug-in hybrids are digested. People are accepting what we are telling them, and they know that we are, let's say, not only marketeers, but it's a true product. So we always say that the products which are coming next, they have two things. They will be more performing, and this is even though they have a hybrid system, and they will have less CO2 emissions. So we will continue to promise this, and the things are going very well on the Revuelto, and also now that we presented the Urus SE, it's something which is astonishing, though the feedback is very, very positive.
Well, let's talk a little bit more about that, because of course deliveries don't start until early 2025, but give us an early peek at demand. What does that look like?
On the Urus or in general?
On Urus.
On Urus, very positive, because today we are sold out on the actual one. We opened up the system for the new one last week, and we already had pre-orders. They will now be translated into the system, and I can tell you that already now we are almost at the end of 2025. So we have already an order bank of 1 year after 1 week.
Have to imagine that feels pretty good. I think a lot of automakers would envy that position there. But so you have 2 plug-in models right now. When you think about fully electric cars, though, true EVs, is that something that Lamborghini would ever do?
But we have a clear strategy. The first thing, we have 3 models today. The first 2 we are hybridizing now, the Vuelto and the Urus. Then there will be the third one, which we will present in the second half of the year here. Also in the US will be the world premiere. And this will be then, let's say, the closing of the first step of our strategy to have all the lineup hybridized. And then we're looking forward by the end of this decade to have a 4th model, which will be then our first full electric car.
Interesting.
Yes, it's interesting, but we also see that the things change. We will see. We don't need to decide a lot on the 3 models we have today for the future, so we have more time to decide what to do next, if we stay hybrid or if we go full electric.
So there's 2 things I want to get into there, both the timeline and the 4th model. Let's talk about the 4th model first off. What could that look like? Are we talking about, another SUV, maybe a 4-door sedan?
If you look into, let's say, the lineup of a super sports car company, you have the pure super sports cars like the Revuelto, and then for us, due to our tradition, we had also the first SUV in the 80s, which was the LM002. So the Urus came naturally. So what is missing in a lineup like ours, and also due to our DNA, was a coupe, a 2+2, a GT car. So we have, but in a modern interpretation, so we have more ground clearance. It's a 2-door and a 4-seater. So something which we're looking forward to, and I think it's going to be very successful.
Well, definitely going to stay tuned there. That sounds really interesting. Let's talk a little bit, though, about the timeline for fully electric, because even when it comes to the hybrids, I mean, you've taken a very deliberate approach. Some would call it slow relative to a lot of your competitors. And I mean, I really can't imagine what the EV landscape looks like by the end of the decade. Why move so slowly here?
But we always said we want to be the best when we arrive, but we don't have to be the first ones. When it comes to design and performance, we always want to be the best. But this type of technology, it's about acceptance. And for us, we are not selling mobility, we are selling dreams. So it's very important to continue to have people which are really dreaming about our type of cars. We continue to work where the others stop. And I think that also in terms of the full electric cars, there will be a time and place where they will be more accepted also for our type of customers. Not for the super sports cars, there we have more time, but more for the daily users. Because the infrastructure, but also, let's say, the technology is going to help us in 5 to 6 years from now. And also there will be a new generation stepping in of buyers, which are more into sustainable products.
Well, I told you a little bit before the interview that it's going to be a while before I can afford a Lamborghini, but we'll see there in that new generation of buyers. And on that point, let's talk about pricing power. Obviously, you can command very, very high price tags for your cars. Where are we in the cycle when it comes to pricing power?
You know, for us, it's important to always sell less than demand. So actually, we have an order bank which in average is lasting 2 years on all the products. And when you buy these type of cars, you accept that you have to wait. It's good because you're on the other side. When we speak about residual values, they have to be very high. And if you want to buy a Lamborghini today, usually it's above its MSRP, even if it's a used car, because you don't want to wait. And this is a good moment, and we want to keep it like this. And we are in a, let's say, an environment of 30 to 40,000 cars. There are some brands, and they all move in the same direction. Some has more success, the others less, and we are in the best shape ever. So our purchasing power is good, and we had the best year ever also in terms of profit last year. We had the best turnover. We delivered for the first time more than 10,000 cars, and we had a profit of 723 million, which is an ROS of 27.2%. So we are really proud and happy about that.
So like you said, 2023, record year for Lamborghini on a number of different metrics. And you actually said in January, this year, late January, that you're sold out of cars until 2026. Is that still the case?
Yes. It's still the case. On the Revuelto, it's even more so. On the top of the line, the V12 with a plug-in hybrid, it's lasting 3 years, so we are already at end of 26. So.
And are you noticing any trends when it comes to geographic demand, what it looks like region to region?
But we are well balanced between the major regions. So we have the US, which is our top market, followed by the German market, then comes China, then comes the UK, then comes Japan, and then we have markets like Korea, the Middle East, Italy, and then Canada. So if we look at it, we are very well balanced in the different regions of the world. And this is also, let's say, keeping us on the safe side when there are local crises.
Well, you mentioned China, and actually wanted to go there because there is a lot of anxiety over, Chinese demand when it really comes to pretty much every industry out there. When you take a look at, Lambo in China, does the market that you're in sort of rise above some of the demand fears that we're seeing in the other industries?
No, the luxury business in general is under heavy pressure in the Chinese market. There's a fierce price battle. And we are not participating, so we are less exposed than others in the Chinese market. We have less than 10% of our sales in China, and we want to keep it this way, because even if China is the biggest market in terms of automotive, it's a very small market in terms of luxury cars.
All right, Stefan, so enjoyed this conversation. Really thrilled that we could make it work. Our thanks, of course, to Stefan Winkelmann, the CEO of Lamborghini.
All right, that was our very own Katie Greifeld. Speaking with Stefan Winkelmann, Chief Executive Officer of Lamborghini, and talking about the future of EVs and how they're going to move there. They've been moving very deliberately by their own admission. They want to be the best when they arrive at a market. So never having owned a Lamborghini, but I do admire
Now, these new versions, I mean, you still get the roar of that engine?
I don't know.
I mean, it's a hybrid, sure, why not, right? Like a hybrid, like their first plug-in hybrid super SUV, I'm assuming that it has the sound because hybrids have the sounds.
I mean, that's be like one